Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surbi. Guys, morning.
Hi, morning.
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 So it's been a pretty decent week so far. The bulls have managed to kind of claw their way back, and we have 2 more sessions to go. So hopefully they'll prevail.
Hopefully, and there's perhaps more repair and recovery in terms of where we head from here. Let's just take it from the top then, quickly. I mean, in terms of news flow from what has happened with President Trump or anything of that sort, I mean, there isn't very much new. So you've got Wall Street overnight action, which is subdued, but S&P, NASDAQ both closing at record highs once again. Small change, about 1/3% higher is where both those markets finally left off at. You also had just a bunch of other things. So Oracle was the big story, right? And we'll talk more about that. Actually, that is the big story overall. 36% gain. Larry Ellison, the legendary founder of Oracle, on the back of this massive move on the stock price, briefly becoming the richest man in the world, pipping Elon Musk. On the back of it, NVIDIA was up 4%. And this kind of sort of, brings into focus, sharp focus, the entire AI infrastructure theme in a pretty sort of prominent way. And this is going to show up in other markets. Look at Taiwan, look at the Korean markets, etc. as well. They've all broken through new highs. And it's the same point that we've made over the last many weeks now, which is the fact that, the lack of AI sort of led pure AI themes in a market like India, is it actually hurting us being able to take in large amounts of foreign money? It's a question. I mean, there's no clear answers, but I think it's something to think about. The 10-year yield, macro markets, nothing very much. 4 basis points lower on the 10-year. Dollar index was largely flat. Brent oil prices about 2% higher. We're at about $67.49. So that's the entire picture. I'll just quickly tie in the levels here. The Nifty, another positive close, and we've been slowly inching up. Resistance line is 24,980, as I've mentioned over the last many sessions. I mean, rounded off 25,000 is that level, above which I think you get more legs to this move higher. Support stands at 24,760. For the Nifty Bank, we are approaching an important resistance level. The resistance is the 20-day moving average, which is 56,584. And then you got the 40-day exponential moving average, which is 55,101. So these are very near-term levels. And I think these are numbers on the upside as we begin our day. F&O stats with Nigel. He's walked across and he's standing by. Nigel, over to you.
Well, the Qs are not looking too bad, right? I mean, if you look at the institutional number, well, that's a net buy number coming from the institutions. Though you need to keep in mind that, yes, that the Kotak Mahindra Bank, a big deal that is part of it. But for the last few trading sessions, what's been a constant is that the institutions have been net buyers. So I like that. The second point is, on the F&O side of things, the FIs for the third straight session, the number of long contracts that were added were more than the number of short contracts that were added. The short position continues at around 90%, but the point is that now long addition has started and that short covering bounce is still pretty much due. So that will be encouraging from a bullish perspective. They'll want to see those shorts getting squeezed out. That's yet to take place, just going by the data that we have. Moving to the Nifty Bank. In yesterday's trading session, after a while, we did see a bit of a short covering bounce did come into play. And I say that because the Nifty Bank ended higher. We came off a little bit from the top, but there were first signs that on the Nifty Bank itself, these shorts are covering out. Remember, when we talk of short positions getting added on index futures, bulk of it was getting added in the Nifty Bank. So now there are some signs that the Nifty Bank, those shorts, they are scrambling for cover after seeing a good run in the last 45 days or so, because shorting the Nifty Bank has made you money. Now those shorts are squeezing out a little bit. Moving to the options data. The 25,000 call and the 25,000 put. Then it appears, just by the look of it, between them, they added close to under crore shares. The combined premium out there on an average will be around 250 rupees or thereabouts. So that's telling you, the markets are bracing for this broad 500-point band that we're looking at. So if you just look at it, someone who's pocketing this 250 rupees, they want the markets to stay in this band of around 24,750 to around 25,250. That's the strategy if there is a straddle that's taking place at the 25,000 call as well as put. For today, 24,800 going by the options data, that's the level that I'm looking at. And 25,050, that's the first level of resistance that I'm looking at. So we'll keep an eye out on that. Moving to the other data point that we have, the Nifty Bank. Yesterday, it went to the 20 DMA. It couldn't cross the 20 DMA. It's important that today, on a closing basis, you get past this level of around 54,700 because that level is getting a little bit rejected. So you'll want the Nifty Bank to conquer this mark. Important trigger to track. Stocks that I'm looking at for today, RBL Bank. If you look at yesterday's intraday chart, intraday there was a sharp dip. And then that dip got bought into. And the stock continues to remain in the F&O band. So there is a good amount of open risk build-up that we're seeing on that particular name. I'll continue to keep this stock on the radar because it still has a few sessions to go before it can come out of the F&O band. Though yesterday there was some shedding. And the other one is Tega Industries, a massive, big, large deal that was announced overnight. Nimesh was highlighting it could be very, very large. Indeed, $1.5 billion. They are going ahead and they're acquiring Molycom. It puts the company in another trajectory for the next few years, but maybe, just maybe in the near term, the street could think that they're looking to bite too big. So we'll have to see the stock reaction. Keep in mind, last 6 months, stock is already up 55%. So longer term good, maybe in fact in the near term, there could be a bit of an overhang because of the leverage on the books. So we'll keep an eye out on this one.
Okay, all right, got that. By the way, in Japan, markets are surging. They're going on to record highs. Asian markets largely are doing okay. The specific headline out of Japan is SoftBank. Thanks to Oracle's overnight dramatic run-up, SoftBank shares are rising 10% because remember, OpenAI, Oracle and SoftBank, a lot of these entities come together in the Stargate program when it comes to AI infrastructure. So, well, a lot of excitement across many of the regional markets. The Hang Seng is actually a little quiet, down about 1%. Well, let's look at the equity call of the morning now. Sunil Kaul of Goldman Sachs says the GST cuts could directly support earnings through higher volume growth due to price elasticity of demand from benefit pass-through, and though better profit margins where companies have the pricing power. He says they reiterate our overweight view on consumer sensitives as they have picked up, outperforming the market by 11 percentage points in the second quarter so far, but still down 5% and flat relative to the market over a one-year horizon, suggesting room for further runway. He says they raise cement and consumer durables to market weight on potential GST tailwinds and ongoing mass consumption revival. So that's a view coming in from Goldman Sachs. But I think we have some news on wholesale prices, Prashant.
I think we got the PPI numbers last night, right? And numbers are, I think, better than what was expected. So it basically strengthens the expectation that we perhaps will get rate cuts, that is on the 17th. This is David Solomon, Chairman and CEO at Goldman Sachs, on exactly the numbers and perhaps the Fed decision, which is right in front of us.
I think about where we are, there's still more work to do. And so, I think it's uncertain. I've said it a number of times, I think there's going to be a stickiness around how this all settles out. And I think we're continuing to see indications that that's something to watch very closely. So trade policy is still getting negotiated. It's still getting implemented. The administration has a clear point of view, but there's uncertainty around where this all lands. And there's no question in my mind that it's having an impact on growth. That impact on growth is hard to quantify specifically, and I think it's also very dependent on where a lot of this lands. There's obviously litigation now going on around some of the reciprocal tariffs. We have to watch that closely. There's still trade deals that have to be negotiated, particularly here in North America. So I'd say there's still uncertainty. There is an impact to growth.
Okay, well, that's the global stuff. It's not very much today in terms of the news flow, but we'll have more coming up in a bit from now. So here's a quick preview of what's coming up here in the next 2 hours. 8:35, Mehul Mohanka, MD and Group CEO at Tega Industries. That's the big outbound M&A, which we want to get to you. It's a big one. And Tega, the stock has done phenomenally well. So you'll hear from them at 8:35. 9 o'clock, we'll have Nilesh Ghuge of HDFC Securities for an outlook on the chemical stocks. 9:20, Harish Krishnan of Aditya Birla Sun Life Asset Management Companies, a market match of the day. 9:35, the management of Cholamandalam Investment and Finance talks to us about the company's second quarter outlook as well as the impact of GST cuts on, the end markets for them. And of course, Gopal Agarwal, CEO of Anupam Rasayan, talks to us at 9:45. Towards the end of the program, it's the conversation with Parvat Srinivas Reddy, MD, MTAR Technologies, new orders in a clean energy segment and the impact of US tariffs are those talking points.
All right, time to slip into a short break. You've got a lot of stock-specific action that we're going to be tracking for you on the other side of the short break. Stay with us.
Welcome back. Let's get the implied open up because Asian markets are mixed, but many of them are up and about. And anyway, our market has picked up some momentum in the last couple of days. So the bulls will hope that they can build on that. Just 15, 16 points higher. Let's see. Quiet start. We'll see if the momentum can come in during the course of the day. Now it's time to get down to individual stocks, and our team is standing by with the CNBC-TV18 list of top stocks to watch. Rima, let me kick it off with you. TCS on the radar.
Indeed, TCS on the radar because CLSA has written a note. This is after meeting the management at their investor conference in Hong Kong very recently. So first on demand, TCS says the demand environment remains broadly unchanged compared to Q1. No change, but they are sounding incrementally more positive about the opportunity from AI. They believe that the overall budget on account of AI opportunity will expand, and therefore it will be a net revenue positive for the company. Secondly, now because Infosys has announced Infosys board is meeting today to consider buyback, so you should watch for Infosys too. CLSA believes there will be incrementally more pressure now on TCS to also do a buyback because they're eligible for a buyback. Their last buyback ended in December 2023, so that cool-off period has come to an end. CLSA believes that TCS can do a 20,000 crore tender buyback instead of paying out a huge special dividend. And analysis shows that the last 5 buybacks that the TCS has done has been supportive of the price. So the price generally during that buyback period has gone up between 1 to 3.7% in every single of those buybacks. So when the buyback announcement comes from TCS, if it does, it will be a positive. Back to you.
Okay. All right, Rima, thanks a lot for that. Well, let's hop across to Sudarshan. He's here to tell us about Tata Motors. Morning, Sud.
Good morning, Nigel. So on August 31st, there was a report of their cyber incident at JLR. So first time JLR had released a statement on September 2 confirming about cyber incident, and the fresh statement company has released yesterday in which company has said that even some data has been affected in cyber incident and the shutdown of its all the operations have been extended. Now, as per BBC reports, cyber attack may cost JLR almost 5 million euros per day, and it believes that this attack has come at the worst possible time because UK government has recently launched introduction of new registration plate, and on the back of this, September was expected to be huge selling month. So it's come at the very very important time. And also the question about cyber attack was raised in the House of Commons, and the reply to the question, Cabinet Minister has said that he cannot confirm or deny that if the attack was state-sponsored. Why it's important for Tata Motors? Because JLR forms almost 70% of the consolidated revenue of Tata Motors.
Okay, well, this is a new one. Cyber attacks and making news in that sense. Watch out for this one as we go forward. Tega Industries, right? That's a big acquisition that we've been sort of highlighting, and the interview comes up a little later. But let's get the news out of the way first. Vamakshi, tell us more.
Well, good morning, Prashant. Absolutely a very big acquisition coming in for Tega Industries. Now, Tega Industries in consortium with Apollo Funds will be acquiring 100% of Molycorp. And now the acquisition is actually a massive acquisition. It's coming at an enterprise value of almost $1.48 billion, or roughly translated to Indian currency, it is around 13,000 crores. Now, keep in mind that Tega's market cap is at 13,800 crores. So the acquisition that they're doing is almost as big as their own market cap. Now, in the SPV, Tega will be holding around a 77% stake, while Apollo Funds will hold a 23% stake. Now, largely, how will such a massive acquisition be funded? Tega will be contributed around $361 million, or roughly around 3,180 crores, out of which 995 crores will come in from corporate debt, while 2,184 crores will come in from the equity raise. Now, keep in mind that there is a board meeting scheduled on September 13th in order to consider fundraising plans. Now, Now, the rest of the amount, which is approximately 951 crores, will be contributed by Apollo funds. Apart from this, there's $120 million contingent payment, which will be paid within 45 months. Now, this overall acquisition is quite massive. They believe that they expect closing by 31st of December this year, pending all the approvals are in place. Now, just to give our viewers some context as to how big or how massive this acquisition is, keep in mind that Tega had a revenue of 1,639 crores. Molycorp comes in with a revenue that is 8 times, and the combined entity will have a revenue of almost over 15,200 crores. The EBITDA margin as well for Tega was at 20.7%, but for Molycorp the margins are much lower, 11.5%, and combined 12.5% for the entire entity. Now, this is a massive acquisition, definitely positive, but the street will be looking at some of the operational challenges, plus that because Molycorp is not growing at a rate as fast as Tega, so that is something that the street will be concerned about, as well as the lower margins that Molycorp comes with.
Okay, all right, Vamakshi. We'll, keep all of this in mind as we go forward with that conversation with Mehul Mohanka, the MD and Group CEO of Tega Industries. We'll ask him about some of those questions, those operational challenges, and of course, the way forward with this big $1.5 billion acquisition. Okay, back to some more stocks in news, and Vinny has rounded up a couple on her list for us. Vinny, good morning.
Good morning. So firstly, I'm going to start with Dr. Reddy's. They've signed a definitive agreement with Janssen Pharmaceutica, which is an affiliate company of Johnson & Johnson. They'll be acquiring Staggeron, which is one of the products of the company, for $50 million. Now, this is a positive that comes in for the company because overall, the Indian market sales also for this product and this brand is around $10 million. There are sales that will be happening in other 18 markets across the globe as well. APAC is included, EMEA is included in the regions. India, Vietnam are some of the other regions that they'll be selling these products in. So positive there for Dr. Reddy's. The other one is Shyam Metallics. We're expecting green here as well. They've had made a strategic foray into crash barrier segment. They're aiming to capture around a market share of 8 to 10% in FY25 to FY26. So that'll be interesting to watch out for them. RVNL, the company has emerged as the lowest bidder for a project from Western Railways, and this is for a consideration of 169 crore rupees. The execution period is 540 days. That's 1.5 years approximately. Jupiter Wagons, that also we're expecting green. They've received a letter of acceptance from Ministry of Railways, and this pertains to around 9,000 LHB axles, and this is for Fiat IR bogies with an aggregate value of around 113 crores. So keep an eye out on all these stocks today.
All right, Vinny, thanks very much for that. So keep an eye out on these names, individual stock-specific movers. Block deals in focus, right? Vivek is standing by now. Kotak Mahindra Bank, HCG, and Bejal projects in focus. Vivek, take it away.
Well, good morning. Yesterday we saw a whole host of block deals, none larger than Kotak Mahindra Bank, over 6,000 crore of equity exchange hands. Along expected light, SMBC holding close to 1.6% stake. Sumitomo exited the stake completely. Whole host of buyers, key amongst them being one of the top buyers was 361 Asset Management, almost 2.6 lakh shares was the one they bought. Adia, which is Abu Dhabi Investment Authority, picked up close to 1.3 crore shares. In another fund, they actually bought close to 53,000 shares, and Aditya Birla Sun Life Mutual Fund bought over 2 lakh shares. So whole host of buyers, these are among the top names. So again, Kotak Mahindra Bank expects a slight green tick here, given the fact that the overhang of SMBC stake sale is now over. Healthcare Global, very interesting block deal. Remember, CVC, which had actually exited majority of their stake, almost 54% stake to KKR in February, they were left with close to 8.76% stake. Now, yesterday's block deal, they sold close to 79.4 lakh shares, indicating that they exited most of, their stake in the company yesterday. Axis Mutual Fund bought close to 9.5 lakh shares. Morgan Stanley bought close to 8.8 lakh shares. Nippon India Mutual Fund bought close to 44 lakh shares. Now, what we understand is that in other off-market transactions, they've actually gone ahead and completely exited their stake. So the entire overhang of CVC Partners' stake in HCG is now over. And lastly, Bazaar projects. HDFC Mutual Fund yesterday sold close to 8.9 lakh shares in this particular stock. Expect some overhang on the back of this particular development.
Okay, all right, Vivek, got it. Thanks very much. Let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow would be TCS, Tega Industries, Dr. Reddy's, RVNL, Jupiter Wagons, Shyam Metallics, Kotak Mahindra Bank, and Healthcare Global. Stocks with negative news flow would be Tata Motors and Bedrell Projects. Okay, so that's the news flow and the top stocks based on news this morning. Let's also look at some interesting brokerage notes. Sudarshan is joining in for exactly that. So good morning. What do you have for us?
Good morning, Surbhi. So first one in the brokerage corner list is GAIL. If you remember, we have been reporting about imminent tariff hike, and that hike is expected over next few days. Now today, Nomura has come out with a note. It maintains buy call and target is of rupees 225. It believes that tariff hike might give a one-time boost to the company. And as per our reporting, when we had reported that tariff hike can be approved, and it can be approved at the level of rupees 70 per MMBTU versus current tariff of rupees 58 to 59. Even Nomura believes that tariff can be increased to the same level, that is rupees 70, and it can be applicable from April of 2026. And also, if once it's increased, it would be a 20% increase. And on the back of these factors, it believes petchem segment could recover from FY27, and also it expects 42% increase, 42% YY increase in gas transmission EBIT from FY27. Next is on HSBC has written on agri input companies. It believes that sector is regaining health as industry dynamics have turned favorable, and also outlook by agri majors appear encouraging. And in H1 CY25 performance, major China companies, they had also indicated that prices are bottoming out, and on the back of this, it maintains buy call on UPL and target price is rupees 775. Last one is Citi has written on OMCs. It says it stays in the bullish camp, recognizing several undeniable strengths, and believes that Q2 for these companies is expected to be much better than Q1, and market sentiment is being weighed down by concerns over Russian crude imports. But Citi believes that even if Russian crude imports come down, the impact will be very minimal, and it prefers OMCs over its counterparts in the upstream segment.
Okay, all right. So thank you very much for that. So some brokerage calls, and we'll put out more as we go along. We'll take a quick commercial break here. Next up, that much-promised interview with the management of Tega Industries coming up on the big announcement, a big acquisition that they are making, and what it means for the company, how will it change the trajectory, all of that with Mehul Mohanka of Tega.
Welcome back. Hope you're having a good morning. Well, let's get to the big deal that was announced yesterday. Tega Industries is partnering with the Polo Funds to acquire Molycorp in a $1.5 billion deal. To help us out with how this transaction is and give us some clarity with regard to it, we're joined by Mr. Mehul Mohanka, the Managing Director and Group CEO at Tega Industries. Hi, Mehul. Good morning. Thanks a lot for speaking to us here on CNBC-TV18. Well, let's get to a couple of aspects then. How much of debt comes in from the acquired entity? If you could help us out with that, what is the debt you're going to be getting onto your books?
Currently, the debt at the target level is roughly about $1 billion, and the attempt is to bring the leverage down after the transaction closes.
All right, Mehul. How much do you target to bring this debt down? As you're saying, you're looking at bringing it down. Give us a sense as well on what's the broad borrowing cost?
Yeah, sure. I think, through the consortium arrangement that we have with Apollo, the intent is to structure the debt in a fashion that we leverage it down to around 800 million odd levels from the current billion. And that should help us deliver some improved benefits in terms of interest cost reduction with the leverage coming off, and hopefully even an improvement in the credit rating.
All right, Mehul, I just missed out. What is the current cost of borrowing? If you could help us out with that number.
So the current borrowing cost is roughly around, 835 bips, somewhere in that region. We don't have all the specific details yet, but the attempt would be to try and improve on the current rates.
All right, Mehul, though the valuations are looking attractive, the problem is that Molycorp revenues, they have not grown, in the last few years. So my question to you is, what are the scaling up plans of this acquired entity, that's Molycorp? And obviously you have hinted at some margin improvement. So give us some color on that as well. What is the margin improvement we're looking at from around this 11%?
Molycorp has generally been a 3.5% growth business year on year, and that's true of its, I would say, 1 decade history. The attempt is to bring two complementary businesses together in a way that we can improve better value proposition to the customer so that they benefit from this combination of two complementary product lines. And that would hopefully help us deliver a better margin profile for both businesses, both Tega and Molycorp. So I think where Molycorp today operates at is at roughly around 11% EBITDA levels. Our aim would be to try and improve that over the next 2 to 3 years to, on an average, anywhere between 13 to 14% levels. Tega, as you know, operates at a CAGR of 15%, delivers about close to 22% EBITDA. So the margin profiles are different, but we hope that on a consol basis over a 3 to 4 year period, we would be roughly at about 18% on a consol basis.
Mehul, morning, and congratulations on the announcement. It's a big one. Help us with the terms of payment for this transaction, because this is at the end of the day a leveraged buyout. How will this work?
Both Apollo and Tega are going to be funding this transaction through a mix of equity and debt. Tega is going to be putting in about close to $361 million for a 77% stake in the business. Apollo would be bringing in the rest. And so that's the overall capital structure at this point.
Okay. Can you, Mehul, just exactly break up the funding? I mean, who's bringing in how much on board?
So as of now, this is still very indicative and early into this transaction. So the way we're currently thinking around it is to bring in about $118 million, close to about 1,000 crores in debt in the books of Tega, and the balance about 248 odd million in a primary fundraise.
Okay.
That will be through a mix of pref and QIP.
Okay.
That we'll be bringing to the market. Of course, these are still very indicative in early years. We may think of probably replacing some of the debt numbers with equity if it so happens to be.
Mehul, let's talk a little bit more on that equity fundraise then. You're talking about around $250 million, right? $250 million. How much of that will come in from the promoter group?
The way we're thinking right now, promoters would put in, as my family, we would put in about close to $20 million.
$150 million of equity raise. Got that. So Apollo is going to be part of the SPV, but will they be participating in this particular equity raise at Tega Industries itself?
So there's an indicative interest from Apollo to also participate at the Tega in the Tega cap table, other than just the target. And currently, we are going to launch a roadshow to try and reach out to as many institutional investors, HNIs, who would want to participate in this transaction with us.
Right. What is the level of promoter holding that you're comfortable with?
So all things going well, we expect the promoters to go down from 74.8 to roughly around 64%.
Okay. And which year will the deal become EPS accretive from?
On a conservative basis, we would say it will get EPS accretive from, I would say, between the second and the third year.
Okay. Mehul, it's a big deal. I'm sure you've thought this through. But in case investors in the street are not too happy with it, because it's a large deal, you have to raise a lot of money. There's debt coming in. The entity you're acquiring also has a large amount of debt. If the street doesn't like it, will you rethink?
I hope the streets actually are as enthusiastic as I am. I think a couple of reasons. One is, of course, that all the debt in the target has no recourse to Tega. It is value accretive for Tega and the target as well. We've had, as Tega, we've had experience of running businesses globally. We've turned around businesses. We've acquired businesses. So while the scale is sizable, remain undeterred based on just the experience that we've had in working in the global environment. So we're very bullish that we're going to be able to pull this off.
Well, absolutely. Good luck to you with that. But just dive a little deeper in terms of what all does this entity Molycorp bring to the table, and what was your thought process? Because you are going in for something, which is pretty large in size.
We first looked at this asset way back in 2017. So this asset first became available in the market in 2017 when their parent, which was an Australian company, decided to sell the business. And in 2017 was when I had a first look at the business, but we didn't have the currency to be able to participate in the transaction, and the current owner won the bid. And since then, they reached out to us to look at whether there's a possibility of how Tega and Molycorp could work together, because they very early on realized that there's some value in combining two complementary businesses. And when they looked at the entire global space, they saw Tega to be someone that could be interesting for them. And that's how the first contact got established. They visited us in India. We had a long, meaningful interaction, but then just the structure, what they were proposing was something that I thought was not very interesting at that time. And since then, they've owned the business for about 8 years now. I have been tracking this business, so it's been something that's been sitting on my mind for many, many years. It's not something that I just jumped into in the short term. We've been thinking through this about how we could put two complementary businesses together. And just this opportunity came along when, it's been an 8-year vintage for the private equity firm. They wanted to exit this business, and they thought that the best home for this would be in Tega. And the fact that we could probably do better with this business over time than what they've been able to do.
Mehul, in the last 5 years, your CAGR has been roughly around 19-20%. Your margins have been at around 20%. But you're clearly very ambitious. We'll have to see how the street reacts. That said, 3 years down the line, what could the consolidated revenues look like, the margins and the debt as well? Give us some guidance for 3 years down the line.
Yeah, so in our model, we've taken like a revenue growth at a very conservative level for the target. We've maintained it at about 3.5% to 4%. They're currently doing about that much. So without putting in too much of high growth pressure on the target upfront, we've kind of modeled it on a conservative basis to be around 3.5% to 4%. With Tega consistently delivering at about 15%, we're looking at leverage to come off by year 4 to about closer to 2 times of EBITDA, 2x, 2.5x EBITDA over 5 years. And we should be at an EBITDA level of close to about anywhere between 17 to 18% from third year onwards on a combined basis.
Okay, well, good luck to you with those plans, and may all your targets be on track. Thank you very much for joining in and patiently taking all our questions and explaining the deal contours to us. Well, that's Tega Industries, big newsmaker of the day, acquiring Molycorp for $1.5 billion. Well, let's discuss this and lots of other fundamental ideas with Dipan Mehta, Director, Elixir Equities. Dipan, good morning. Good to have you on. I don't know, I hope you could hear most of that interaction, that interview. It's a large deal, and the promoters are saying that it should become EPS accretive from year 2, year 3 onwards. They're looking at putting in, I think, 250 million was the number he gave us in terms of equity funding and getting more investors on board. Your thoughts on how you'd look at it? Otherwise, the stock's done really well. It's been a wealth creator over the last many years.
Yeah, Subhi, good morning, and thank you for having me on your show. I think all I can say is what ambition. I was just checking while you were talking, the actual market capitalization is 13,000 crores of this company, and is doing a 1.5 billion fully leveraged acquisition. So I'm sure they've thought through it, but from an outside investor's perspective, it does sound a bit risky. And there are always integration issues. And actually, the track record of Indians buying global companies has not been that great, right? From Suzlon days or whatever acquisitions Tatas have done. I don't know much about this deal, but just on the face of it, it seems to be kind of a risky deal from the investor's perspective. I'm sure they have thought through it, but it does put a cloud of uncertainty because there are a lot of integration issues, and managing overseas operations is not that easy, as many companies have realized. And it's not that the stock is really attractively valued, it's richly valued. So I wouldn't say that, just because of this deal, one should look at Tega Industries from an investment perspective. But sure, I think sentiment is better, so you could have a spike today.
I just want to pull that chart up itself, which is on the screen right now, the revenue breakup between the two entities. If you look at it, the revenue currently is around 1,650 crores, right? Now, going by what the management had to tell us, that the core business will grow at around 15% for the next few years, and Molycorp will grow at around 3 to around 4% business. So, ballpark, the revenue should be in that vicinity of around 17,500 to 18,000 crores. And at 18% margins would effectively mean 3 or 4 years down the line, the EBITDA number will be nearly 2x of what the current revenue number is. But that is 3 to 4 years down the line. So, the next few years, it could pan out very, very well. The problem is, are they looking to buy too big? That's what could weigh in the near term. And considering the stock has run up, that could weigh as well. But in the longer term, if they go and execute, then it could be a pretty interesting prospect. So, we'll have to see how that goes. But the run up in the stock, I think, is something that, could hurt as well. Deepan, good to have you on the show. Deepan, let's get your view on tech. That's come back out of nowhere. A few sessions ago, we were pointing out that the Nifty IT index, if you compare the premium that it trades in comparison to the Nifty's valuations, that premium has come down, and the discount it trades in comparison to NASDAQ, well, that has widened. In the last month or so, it's done quite well. Would you believe that it's time to book some profits, or do you think they're starting a fresh leg?
No, Nigel, I'm still bearish on IT stocks, and this particular rally has been triggered by what Infosys buyback has done, and we expect other companies also to do buyback. But end of the day, I think that there's nothing really changing fundamentally positive for these companies. Sure, a better US-India deal may improve the sentiment of all exporters and remove the threat of any action or any tariff on Indian services. But end of the day, these companies are really, the large cap ones are really struggling to grow even at mid-single digits. You may find good quality mid-cap companies, but they are quite expensive, like say Persistent or Coforge. But by and large, I think it's still an avoid for us. And such rallies are good exit opportunities for investors who have been invested for multi-years in such companies and suffered, I would say, subpar returns for the past several years or so.
Point taken, Deepan. What else? Good morning. What else is of interest as we're getting a bit of a lift finally from the lower end of this range that the market has been in, and we've inched now closer to about 25,000. What's still looking attractive to you?
Good morning, Prashant. Yeah, I think that this market is going to get extremely selective, and within the sectors also, some stocks may do well, some may not do so well. This entire GST cut also, I think, is going to result in quite a few winners as well. We're looking at retail companies quite closely. One company which comes to mind which will benefit is, and it's attractively valued, a small cap stock which is on our radar, is Keval Kiran Clothing. And if you see the numbers, I think it's among the best performers in the retail segment. I think 50% plus quarterly growth. And it's a company which has been around for a very long time. And valuations also are quite reasonable, very strong brand, good distribution network, backward integration to manufacturing as well, and quite a stable company with good balance sheet and good corporate governance standards as well. So like that, I think selectively we are trying to find industry by industry decent stocks to invest in. Also, I think a lot of the platform companies, and we have another one coming, urban company, looking at that very, very interestingly, maybe on listing if it's reasonable. This is one company which has caught our eye. The way other platform companies have done recently, the likes of Zomato, Paytm, I think that's also got a good, I would say, growth prospect, and certainly merits a look in over there. And then, of course, the large cap companies like Bajaj Finance, L&T, M&M, I think their prospects certainly look very good, especially after this GST cut.
Yeah, the name that Deepan was talking about is Keval Kiran. The code is KKCL.
KKCL, that's right.
For our producers to pull that. Yeah, there you go. That's the one. So 540-ish on that's the one that Deepan was talking about. Survi.
Yeah. Since you're talking platform companies, just reminded me of the new kid, soon to be new kid on the block. Urban company. I'm sure you've had a look at the structure, what the management's been saying. But what about the valuations, Deepan? I mean, does it make sense to you, or what do you do? I mean, wait, let the pop happen, and then decide.
See, I think, valuing these loss-making platform companies is an art. It's not a science. And all we can say is that, if you have a long-term horizon, like I always said, stocks like Urban Company, Zomato, Paytm, these are stocks of the 2027 to 30 years. And I mean, in that particular year, These are the companies which will really be large, a few of them, and give outsized returns, because that's the time when their businesses would have matured and they'd be solidly profitable and still be able to grow at 15-20% or thereabout. So I like such companies, especially urban company. I think these days the person who sells, the company which sells, is more important than the product or the service originator. So from that point of view, very positive on this company. Let's see how it gets listed. The best way to play such businesses is to buy a small percentage, a small percentage of your portfolio in such a company, and then track it. Then accordingly, decide whether you want to increase the holding or exit the company, because it's a whole process of understanding these companies as well. So don't take a big bite initially. Start small, see how the company shapes up, and then accordingly modulate your investment.
Deepan, I'll tell you, maybe one of the best things, or what I think the market or someone like you will appreciate, is the management themselves. We had them on yesterday. So the management themselves saying that forget adjusted EBITDA and all of that. We believe in the final profit number, and we are hoping to get profitable in the near future. So that's the approach that they're taking.
If I may say something, Surbhi.
Yeah.
A very nice trend which is happening with these loss-making companies getting listed is that they are meeting a new class of investors and who are forcing them to get profitable.
Absolutely. Really.
Till now, they're talking with VCs and private equity. Their thought process is different from our thought process over here.
Yeah, and you've been teaching them very, very well, right? Getting real. It's been all about getting real, and they have been getting real when it comes to profitability. Okay. Anyway, Deepan, stay on. We have to take a very quick break. Come back on the other side, and we'll have the technical setup for the market. Sudarshan and Mitesh will join in with the trading ideas of the day.
Okay, welcome back. Let's just look at the delivery stats as if after yesterday's close. Hormuz is here with the big movers and what's behind the price action. Hormuz, morning, take it away.
Morning, Prashant. And starting off with the PSU name, ITDC, and that's because of the fact that it was a big mover on Tuesday. And yesterday, for the first part of the trading session too, the stock extended its gains, but then fell significantly from the highs. Fell almost 8%, ended almost at the flat line as of closing. But the interesting bit is the fact that yesterday's volumes, despite the fall from the highs, were higher than the time when the stock rose on a Tuesday. So yesterday's volumes was equal to the last 64 sessions put together, and this is including the 26 lakh shares that were traded on Tuesday. And in yesterday's session, more than 40 lakh shares were traded compared to a 20-day average of a lakh and a half, and close to 5 lakh shares were marked for delivery compared to a 20-day average of just 24,000. Now, mind you, ITDC does not have any free float in the market. 87% rests with the government, a bit of a stake from with LIC, and almost 7 to 8% stake is with Indian hotels. So very little free float in the market for ITDC. The other one is Alcon Engineering. That did well in yesterday's session. The biggest single day gain since January, has gained in 7 out of the last 9 trading sessions. The volumes were the highest since July, almost 55 lakh shares traded compared to a 20-day average of just close to 2.5 lakh, and 7 lakh shares marked for delivery compared to a 20-day average of just over 1 lakh shares. So, and of course, it is known for the fact that Vijay Kedia owns stake in the company, but he has trimmed that down over a period of time. Now has only 1% at the end of the June quarter. Phase 3 is the other one. It was up 20% yesterday. It is into a similar business line as compared to Welspun Living, into manufacturing of bath linens and so on and so forth. That was up in an upper circuit yesterday. The biggest single day gain on record. Has almost 6 lakh shares traded yesterday. 20-day average of just over a lakh, and close to 2 lakh shares marked for delivery. A 20-day average of just around 42,000 shares. Has no institutional holding, but Ashish Kacholia does have over 5% stake in this company. And lastly, Apex Frozen Foods. Of course, yesterday's buzzwords were textile and shrimp and exporters. Singling out Apex Frozen because was up 17%. The biggest single day gain since July last year. Close to 1 crore shares were traded yesterday, and a 20-day average is just 3 lakh shares. And even on the delivery front, over 6 lakh shares marked for delivery compared to a 20-day average of just 50,000 shares. And the turnover for Apex Frozen yesterday was almost 224 crore, which is close to 30% of the overall market cap of the company.
All right, Hormuz, interesting names there. Phase 3, so that's the most interesting one that I thought you put out, but a bunch of names there. Let's talk about IT stocks, right? I mean, whole host of news updates here, and Rima is standing by with just a quick update. Rima, over to you.
Thanks so much for that. So 3 things. One, let's start with Infosys. Board meets today to consider a buyback. This was announced a couple of days back, and since then the stock has been doing well. It's rallied 7.5% in the last 2 days, and the street estimates it will be a buyback in the size of 10 to 14,000 crore rupees. And remember now, according to the rules, it has to be a tender buyback, which means at a particular price, fixed price. The second set of news is surrounding TCS. Now, there is a brokerage note written by CLSA. This is after meeting the management of CLSA at their investor forum in Hong Kong. So the first takeaway from there is that the demand environment, according to the management, remains unchanged compared to Q1. So not much had changed. But they believe the company is sounding incrementally more positive from the opportunity from AI, and they believe this will help expand the overall IT budgets, and it will be a net revenue positive for companies like TCS. Secondly, CLSA believes that now the pressure is on TCS to also come out with a buyback. Infi has announced it. TCS is eligible. Their last buyback closed in December of 2023. So almost 2 years have passed. So now CLSA says it's, they've passed the mantle on to TCS. According to CLSA, TCS can do a buyback of about 20,000 crore rupees this time around. And they've done five buybacks in the past. And the historical price analysis during buyback suggests the TCS stock price remains supported. So every time during that buyback period, while the buyback is on, TCS share price has gone up, either 1 going up to 4%. And the last bit of news is Oracle. We've been talking about it yesterday. Yesterday when we spoke about it, it was the share price run up in after hours trade, but it followed up. So yesterday the stock closed with a gain of about 36%, its best single day gain since 1992. And what was the key driver? Their cloud revenue projections. Last year, the cloud infrastructure revenue was at $10 billion. This year, they're projecting it to be $18 billion. And by 2030, this number will stand at $144 billion. We're talking about a 7-8 times jump in a span of 4 to 5 years. This number, this $144 billion, got the street very excited. And the other big headline is that Larry Ellison, the founder of Oracle Financial, he's 81 years old, and he's now the richest person in the world. He's overtaken Elon Musk.
I mean, Rima, Larry Ellison doesn't get the kind of publicity to some of the other tech titans, but he's in a sense the OG, right?
Yeah.
I mean, 40, 50 years in the business, very low profile, but shot into the limelight with this explosive. I don't think any large company has produced such a significant guidance ever. I mean, in terms of
now
guidance
there are
and price.
people saying that is it even possible for the company to achieve it, right? You need electricity. I mean, can the electricity go up, right? Electricity requirement, it has to go up 7-8 times. Chips have to go up.
Yeah.
So for that kind of projection, but for now, it's like outstanding, right? It's everyone's fallen off their chairs looking at that guidance number.
Gangbusters. Well, Rima, thank you very much for that. And that's a big story which we will continue to track through the course of the day. Sudarshan and Mitesh are with us with what they'd want you to do in terms of specific trades right now, technical trades. Gentlemen, morning. Great to have both of you here. Sudarshan, you go first. How are things looking? We are now approaching almost at 25,000.
Yeah, good morning. And we are in an uptrend. So there is a very simple process. You buy every dip, you hold on to your long positions, and you buy a small consolidation if you are not in the market. Let me quickly explain the structure and how it developed. Last Monday, we had a trend day. Till that day, the market trend was downbeat. On Tuesday, after the trend day, the trend changed. And actually, it doesn't feel as if we are in an uptrend. The market is going up 30 points, 40 points, 50 points a day. But we are up 300 points from that day. Sometimes this is how the market behaves. It doesn't give a sense of an uptrend, but it does move up. So don't go after the sense. Understand that the trend is up and stay long.
Okay, got it. All right, got that. What about Mitesh? What's your take on the index?
Yeah. So, I've kept a mildly positive bias as well, while believing that the broader move is still within a range. We are kind of heading towards the upper end of the range. Now, the level which I'm watching on the upside is 25,150. And then there was some consolidation which happened in the month of July around 25,250-300 zone. So I think these are the two targets which I'm looking at. We will most likely inch up and head towards those levels. A breakout beyond these levels will, turn the market into a much more positive setup on the medium-term charts and can give you a sustained up move. So for the time being, trade with a positive bias. Look at the markets heading towards the upper end, and if there's not a significant retreat from there, I think we are in for a good couple of few weeks to come by.
Okay, all right. Let's get into individual stocks then. Mitesh, you go first. What's on your radar?
Morning again, Nigel. I have all buy calls today very clearly, in line with the fact that my belief is that we are inching higher. So I have a buy on Jubilant Foods. Here I would recommend buying with the stop at about 645 for a target of around 680. Buy on Bank of India, which had a very good pricing volume action. So mild pullback, buy around 116 half. Keep a stop below 114. Look for a target of 121 to about 122. Similar setup happened on the charts of BEL. So on a mild pullback, let's say around 387, 385. Buy with a stop below 380 for a target of 400. And the final buy call is from the IT names. And post that Infosys announcement, I think a lot of IT names have given a short-term reversal. So HCL Tech joined the queue yesterday. I think that's a buy with a stop at about 1450 for targets of around 1500.
I've got that. Sudarshan, what about you?
Well, it's an all buy list. HDFC Bank is the large cap that comes in my buy list. Buy with a stop under 946. And if you are a positional trader or an active investor, don't keep a stop. Just buy HDFC Bank for the long term. Marico is a buy with a stop under 722. JSW Energy is a buy with a stop under 507. And Mazagon Docks is a buy with a stop under 2704.
Yeah, got that. And that's a pretty significant kind of all these these sharp movers yesterday. Apex Frozen and a bunch of other names. Avanti Feeds. Mitesh, anything caught your eye? Not typically the space that we focus on, or you've looked for in trades.
Yeah, I think the only one which actually was Gokuldas Exports and Avanti Feeds. Avanti Feeds, because of the fact that there was a big gap up, the volumes numbers were I think about 50, 60 times than the average volumes of the last 10, 12 days. So big breakout taking place over here. Typically, you might have some kind of a pullback. So if you get it around 740, 730 range, that's the range to enter afresh. If you're already holding, I would look at a target in excess of around 825.
Gentlemen, thanks very much. Both of you, appreciate it. Sudarshan and Mitesh for those trades coming through right now. We'll take a quick commercial break here. We'll come back with the pre-opening. And of course, we'll have Nilesh Guge of HDFC Securities for an outlook on the chemicals space coming up in short order.
Welcome back. That's a large order. Kalpataru has just announced 2,720 crores, TND Buildings Factories business. And the stock has also been doing fairly okay. Deepan, thanks for staying back. Any new ideas, anything new? Kalpataru news is just flashing on the screen. Auto stocks have had a great rally. So give us some more names, some new ideas.
In this Kalpataru itself, it's a great story. And it started with transmission distribution, and now it's into many other infrastructure projects and phenomenal order book position 3-4 years or so. Another company in the similar line which is worth considering is Transrail. And if you compare Transrail, Kalpataru and KEC, Transrail has the best growth dynamics, reasonable valuation also. And all this renewable energy is really driving the revenues for such companies which are into transmission towers, or into transformers for that matter, overall, when they're into any power distribution equipment. So that's, I think, a high growth sector at this point of time. And there are many ideas over there. And again, now look at these, these solar equipment manufacturing companies, the way the orders are coming, whether it's Premier or Vari or Vikram Solar, I think all of these companies, we are seeing a great deal of growth. I think they've been subdued because of the Trump tariffs, and therefore exports to US may get affected. But domestic demand excluding US also has turned out to be very good. And these companies are all going for backward integration to improve their margins. And again, sitting on 3-4 years type of an order book position, reasonable valuations in a high growth sector. So I think these are the pockets that investors need to look for at a time when a large swath of companies, large sectors like software, like FMCG, to an extent pharma, there's hardly any growth. So we have to look for such pockets, such niches, to find the higher returns per se. Oh, shit.
What a...
Sorry.
No, you're there.
Okay, we can hear you. We can hear you.
I thought I was on mute. Sorry about that. Yeah.
No. We would have... You're perfectly audible. You're perfectly fine. But happens. The rupees opened as well, 88.12 compared to 88.1. That's essentially the last close. So absolutely flattish is where we are starting. Deepan, in the financial space, gold is the one segment which continues to run higher and higher and higher. What is your sense? I mean, there are those who say, so it's a simple thing, right? If you look at gold, the tonnage with gold companies, gold finance companies, that is not going up in proportion to the AUM growth, which means, it's a broad conclusion that it's the price of gold which is going up, which is enabling existing customers to borrow more. So as you keep going higher and gold prices keep going higher, you think the risk goes up a little bit at the margin? And it's related to gold prices, and if they see a pullback, in terms of actual end losses for customers, but we've not had this kind of a gold rally, so we don't know. But historically, losses, credit costs are very low. I'm talking about names like Muthoot, Manappuram, etc.
See, that's right, and Manappuram is very different from Muthoot and some of the other gold financiers. They're really nice, conservative, highly focused, system-driven gold lending company. And they have dealt with such corrections in the past as well. So, they will have their risk management parameters in place as well. And certainly higher gold prices means that they can lend more easily. These loans are typically short-term loans, very good spreads between the gold loan and what the rate of interest these companies are buying at. In any case, lower interest rates, higher liquidity benefit NBFCs. So very positive on gold loan companies. But Manappuram more than Muthoot. Muthoot has got into many things, and especially their microfinance division that has been bleeding, and they're going into so many other products, and that's kind of, vitiating their focus area. Whereas Manappuram is sticking to its knitting, and that's very positive.
Since we're talking NBFCs, Deepan, we're getting to speak with the Chola Finance today. And obviously, we'll find out what the GST cuts mean for the large chunk of their business, which is autos. But otherwise, how do you view Chola? And tell us if you want any specific questions to be asked of the management. Of course, we'll take that forward.
So first, a disclosure, it's one of my favorite NBFC companies.
Okay.
Invested in it for past several years or so, along with Bajaj Finance. And again, I think a superb management, great systems in terms of managing risk. When the entire NBFC sector was going through turmoil, this is one company which managed its NPAs really well. They are slowly and steadily getting into many products, including housing loans and a lot of other products and other loans as well. And of course, the core business of vehicle financing, they have a very nice niche over there. So very positive on the company. I think it trades at a premium multiple, maybe even higher than Bajaj Finance. I'm not sure. So all you can ask them is, how are they managing the competitive intensity? Because gradually this entire lending business is becoming a red ocean. And with PSU banks coming back big time now that their problems are solved, I think the entire banking NBFC really need to see how they can lend safely. That means grow the AUM and yet not have NPAs 2-3 years down the line. That's a big challenge. And that's what we are trying to understand from a whole host of banks and NBFCs.
Yeah, absolutely. They've done well. Year on year, growth of almost 24-25%. They've done well in the first quarter as well. But we'll definitely talk about that competitive intensity point, and we'll discuss what their plans are for the rest of the year. Thank you so much, Deepan, for joining in.
Let's keep Deepan on.
Oh, okay. Deepan.
Let's keep Deepan in. Yeah, please.
Okay. Deepan, so I think we still have a couple of more minutes, so we can quickly toss some more questions. I just wanted to ask you about these big large cap auto stocks, which have run up so well. So what should the approach be if someone's been lucky enough and managed to catch that 15-20% run on the stocks? Do you book profits, get out, or is this a longer term story that's fully entrenched after the GST cuts? So, and if you would buy anything in large cap auto, what would it be?
No, I think this auto rally has more legs, and we may be surprised by the numbers which come through, not immediately, but I think by November, December or so, and Jan is always a great month for these companies. But really the preference has to be for M&M, and I would rate M&M as the best auto company in India at this point of time. Again, disclosure, we and our clients are invested in it from many perspectives. First of all, big beneficiary of GST, a big beneficiary of very good monsoon because a lot of sales are from rural areas as well. An excellent rollout of models, and top of the line, strategy when it comes to EVs as well. So I think it's completely turned itself into one of the most vibrant auto companies, much better than Maruti, which is just still stuck in this hybrids and ICE vehicles, and still do not have a credible EV strategy. So very positive on M&M, and different products will do well for them as well. Like tractors is a smaller division, but higher operating profit margins, and they are increasing their market share as well. So as this is one company which you can make as a part of your core holding. And of course, Nigel is on the show. We cannot keep, we need to stop talking about Eicher Motors per se, but that's also done very well. And I think that also has got some more, way to go up. But again, disclosure, we and our clients are invested in these stocks.
No conversation can go by if there's Dipan and Nigel, and if Eicher is not discussed in one way or the other.
I have to confess that today I'm going to be trying out a new motorbike. It's a 650cc, but it's not a Royal Enfield. Just since we are talking about it this evening.
New set of wheels coming. All right,
Next
all
year.
right. Okay. Let's, for the time being, just shift focus and put the spotlight actually on the commodity space, on the chemical space actually. And understand what a lot of this tariff talk has meant for Indian chemical companies so far. We have Nilesh Guge, institutional analyst at HDFC Securities, joining in. Nilesh, let's just keep it very simple and start right there. So, since the tariffs came over, first 25% and 50%, what have been the changes, if at all, in the supply chains and, in shipments from India, in our imports from China, whether you're looking at agrochemicals or, let's say, API? Just tell us what the bare basic changes have been in terms of volumes, the inflow and outflow when it comes to specialty chemicals last few weeks and months.
Yeah, so see, the thing is, the things are evolving. Yesterday also there was a news that there is a bilateral discussion is going on between US and India government. So these things are evolving. Yeah, you are right. 50% tariff from the US on the India. So one should look at the commodity and the specialty chemical in different way. So the impact will be adverse on the commodity. In our opinion, we are of the opinion that commodity will be hit hardly because of if this 50% tariff on Indian manufacturers remain intact. But on the other side, if we talk about specialty chemicals, then it varies a lot depending on the chemical, the end use. For example, if suppose these chemicals are used as a additives, or there is a clear-cut advantage that Indian manufacturers enjoy because of the process innovation, then customers will continue to buy those chemicals. There should not be any impact on the volumes. They will ready to pay, or the customers will be ready to pay the higher prices, including the tariff. But things are evolving. We hope that tariff may come down a little bit after this fruitful discussion between India and US government.
Little bit, Nilesh, it will come down, that 25% will go. You'll be at 25%, right? And then that 25% perhaps is worked down.
Yes. So let's hypothetically, suppose this 25% tariff remain, then there is a news or the article suggests that Chinese, which are the competitor as far as the chemical industry is concerned. So Chinese manufacturers are competitors for Indian manufacturers, where there is a tariff between 27 to 30%. So there clear-cut, there is an advantage that Indian manufacturers will enjoy. But at the same time, we should look at the Annexure 2, if there is a advantage or the exemption.
Yeah. Nilesh, on the back of this, let's say 25% goes, one stock you think which has been beaten down and where you think there is upside? One name.
Yeah, it's difficult to pinpoint anyone, but I will say that commodity manufacturer will suffer a lot.
Will suffer?
Yeah, see, commodity manufacturer, see what will happen if suppose there is a 25% tariff on the Indian manufacturer, which is at par with the, let's say you can say the Chinese manufacturer. Then there will be a dumping from the Chinese. There could be chances that the Chinese manufacturer will dump those products in the market, which are, the non-US market, the other markets.
Nilesh, good luck and good drive. Thank you very much for joining us and appreciate it very much. I think Deepan is with us. Deepan, you want to just round this off? You heard Nilesh there on the chemical space, but anything? I think you'd like one name, right, in that space?
No, I think that let me just understand how these Trump tariffs are going to actually play out, because if there are going to be tariffs on India, then the competitive position of specialty chemical companies, export-oriented ones, certainly gets affected. But by and large, I think it's a good sector to keep on your watch list. Very impressed with last 2 quarters, what numbers have come through, especially companies like SRF and Naveen have done really very well. And I think a dark horse could be Aarti, which has been, kind of struggling with growth and has had minor and major challenges. But now I think all of them are behind that. And again, a very solid manufacturer, a very strong competitive position in the world as well, cost advantage. So I think this is one sector investors should keep on their radar, and you will see an improvement in the sentiment once there's clarity on the Trump tariffs and then what exact position is there of each company in the global space and how much they're exporting to US and where exactly they stand.
All right. Deepan, thank you for staying on. Really appreciate it and look forward to our next one. So that's Deepan Mehta with the perspective on markets. Let's get some more calls out of the way. Sudarshan is back with us. Sudarshan, what do you have?
It's Mazagon Docs buy with a stop under 2704.
Mitesh, what about you?
Well, you go with the long on Jubilant Foods for targets of 680.
Okay, Mazgaon and Jubilant Foodworks are Sudarshan and Mitesh's calls respectively at 9:10. We just want to highlight one more name, right? NTPC. As we run up to the market opening. Vivek is here to tell us why. Vivek, morning.
Well, good morning. The stock has underperformed quite significantly. Power demand has been quite low. Execution challenges has been something that the company has been grappling with. Today, a very interesting note coming from HSBC. They, number one, go ahead and take note and take cognizance of all of these challenges. But what they've done is they've upgraded the stock to a buy rating from a hold earlier. They've also raised the target price to 400 from 385. They believe that the company is at the forefront of power management as well as generation. And they believe the latest, arsenal as far as the company's repository is concerned is battery as well as the nuclear opportunity. Now, what they're saying, what drove the underperformance? Slowness in power demand, delays in execution, and they believe going forward that should reverse. Number one, they believe power demand will actually benefit from what is essentially a low base of FY25. Remember, FY25 actually suffered due to a high base of FY24. Now, along with that, the thermal execution challenges that the company faced, that also is now being sorted out. They believe 2 thermal power plants of close to 1.3 gigawatt have already been commissioned. Along with that, the important part is that significant capex of almost 4 trillion rupees that the company has planned is actually under the regulated tariff mechanism. So an upgrade coming in from NTPC or from HSBC on NTPC, that stock will be in focus.
Okay, all right, got it, Vivek. Thank you very much for that. The pre-open session has settled. It's very quiet, 27 points down on the Nifty. Let's quickly check the stocks that have been in news, starting with Tega Industries. Tega is absolutely flat, not giving away anything. So that's how the market is looking at the first glance, looking at the acquisition. We'll see how it goes. TCS is the one to note because now after Infosys' board meeting is today on that buyback. Now it's all eyes on TCS, whether TCS is going to do something similar. The commentary, as CLSA pointed out in the investor call, was sounding a little more optimistic than what we've heard at the end of Q1. Apart from that, RVNL on the order win, up about 1.5%. GAIL was our standout brokerage note of the morning. That stock's up about 1% as well. It's pretty quiet. Jupiter Wagons won a lot of orders. Keep that stock on your radar. It's up 4% in the pre-open.
All right on Q, we've got the market opening coming up. 22 points lower on the Nifty, 94 lower, 9,800 points lower on the sensex. So those are first rates coming through. It's a quieter kind of start as compared to what we've had over the last few sessions. You've got the small cap index, though, which is starting with about a 0.25% gain. The mid cap index has also got some gain, but nothing very much at all. It's flattish. So it's actually the small cap space, which is out of the 4 indices, looking a little better this morning. So the Nifty heat map should come up in short order, and we'll take a look at what's opening and how many up and down. I mean, it's almost evenly balanced, right? In terms of neither here nor there, no directional push so far. And I think it reflects on the Nifty 50 heat map, almost 25 up and 25 down. Adani Ports, NTPC on one end, NTPC we just pointed out, and of course you've got a couple of life insurance and tech companies on the other side. Of course, IT has seen some reversal over the last 2 days or so. Sylvie.
Okay, Adani Ports, by the way, is a very small acquisition, one of their subsidiaries. Stocks up 1%, a little over 1% this morning. Looking at TCS next, LSA believes could be doing a 20,000 crore rupee buyback at some point, further down the road this year, following in Infosys' footsteps. Infosys itself, today is the board meeting. Stock is down about 1%. It's cooling off after its good run so far this week. Let's see what else is working in favor of the Nifty. Eternal, 1%. NTPC, the stock that we just discussed, 1%. ONGC is also up and about, and there's some buying that's returned to Mahindra and Mahindra, which is up 0.5%. But on the flip side, you actually have more of the IT names cooling off. It's not just Infosys. Even Wipro is slightly lower. Eicher Motors down slightly. And some of the bigger banking names like HDFC Bank and ICICI Bank are lower. Quarter to about 0.5% lower, keeping a lid on the gain. So the net result is very quiet. 11 points down on the Nifty. Nigel.
Well, from the broader markets, there are quite a few movers. And let's take a look at Tega Industries. They've gone to bite big. For the time being, the street has been pretty okay with it, actually. The stock is down, I think, only around 1.5% or thereabouts. They're looking at scaling up big time in the coming years. But, in the near term, that could be a bit of a debt worry. Though they're going to be on the roads and, in fact, trying to raise some equity. So I think 1% down is actually par for the course. One would have feared that it could be down far more. This is only initial rates. Let's see how it goes. For the time being, the stock is down 1.5%. Stocks that are doing well. Indocount, zooming away, massive volumes out there. That stock is bursting at the seam. Just take a look at that. Indocount, not Indo-Borax. I think we should get that one up for you on the screen. Jupiter Wagons, that's the other stock that's doing well. They've received a letter of acceptance from the Ministry of Railways and the Railway Board. Their value is approximately 113 crores odd. So that's why, in fact, that stock is up and about in today's trading session. Diffusion Engineers, that's the other stock, in fact, that's moving higher, I think. Let's pull that one. Recently listed company. That one is holding high with a gain of 3%. Volumes are rather large out there. Oracle, they have disclosed that, what's happening at the parent doesn't have any material bearing on our company. But the street, in fact, is reading it otherwise. Yesterday, it had a big run. Today, it's up another 3.5%. I'll tell you what. Yesterday, there was fresh buying. Today, the shorts could start scampering for cover, and that's why that stock is up 3.5%. MobiWick, another stock that's moved from 240 to 340 rupees. It corrected close to 5 to 8% in the last few trading sessions. Today, volumes are high on that one. So, flattish start on the headline index, but individual stocks doing a thing of their own. Prashant.
Absolutely. And, it's that kind of a day where you don't have very much by way of movement on the at a headline level. But yeah, stocks are a different story altogether. So we'll have more coming up in terms of individual movers. It's quite 17, 18 points in the Nifty, so just under 25,000 levels. And we're exactly at, a bit of a, I think we're at the moving average as well. So 24,980 or 24,990 is around where the 20 days sits as of yesterday's close. So you're exactly there. In terms of where the market needs to, or what the market needs to sort of go above. All right, what else? More stocks in a bit, but let me also get in Harish Krishnan, co-CIO, Head of Equity at Aditya Birla Sun Life Asset Management Company. Harish, good morning. Great to have you with us here. Thank you very much for your time. I think we're talking for the first time since the GST cuts, Harish. So, it's a much debated topic in terms of how much a boost this will give to overall consumption, basically leaving a little bit more money in the hands of consumers, whether categories where the cuts are will see increase or, the money will find its way into other categories. So just that question, Harish, how have you and your team thought about this? You must have had discussions and has your approach changed in any way?
Yeah, I think clearly there has been a pivot from the government side to move into demand side stimulation. Over the course of from 2018 to 2023 and 24, the focus of the government was clearly on supply side, investment, capex, PLI, etc. And there seems to be a material shift in that orientation. So that is the more important point to kind of look at, especially given how investment theme has done so well in the last 5 years and the consumption theme has underperformed over that same time frame. Most of the funds and portfolios are also significantly invested in that investment theme and underinvested in the consumption theme. So that has got market implications. Now, coming to the actual boost to the economy, apart from the sentiment perspective, I think it's a reasonably good boost, both from a function of the tax cuts that got announced in February, wherein, close to about anywhere between 75,000 to 1 lakh crore kind of potential savings would accrue to the top 15% of households, because those are the ones that actually do end up paying taxes. And this one covers the entire set of population, which would be, again, as per what the government itself has put in, a net benefit of anywhere between, say, close to about 50,000 crores. But that's the here and now. I think the bigger thing is if these kind of things continue, I think it is going to lead to a lot more economic activity. One of the key pushbacks of private investment has been the fact that demand has been a bit soft, and therefore there really is no real tearing hurry to kind of do investments, given the obsession that corporates have for ROEs. I think that also kind of changes a bit. So I think net it's a very big positive, and it will require a significant change in portfolios. We've already kind of positioned for it. But I think market will start recognizing it more than the here and now of how the festive quarter, etc., kind of plays through, but more from a bigger perspective of how positioning and underinvested the overall space is.
Hi, Harish. Great to have you on the show. I was just looking at the consumption fund that you guys run, and it's fairly well diversified, right? I think it has representation from telecom, some banks like ICICI Bank as well, of course, names like M&M, ITC, so many more. So the question really is, how do you, can you effectively and efficiently also play consumption through the financials? Or is the direct route simply better? Go own the hotels, or own the airlines or the travel companies or the footwear makers? Or is the financial route a good route? And if that's the case, then what sort of financials? Because banks are very diversified. They have large, corporate books as well. And then you have a few names like Bajaj Finance on the retail side here and there. So just help us clarify the link, playing consumers through financial.
So this was the same argument, say, about 3-4 years ago, where that as the investment cycle comes through, you're going to see financials also being a way to play that same thing. And quite honestly, we haven't really seen that happen, more because they were over-owned at that point of time. Financials, were the go-to place for most funds, given the significant weightages they had in the index, etc. And they were significantly over-earning their profits from very high NIMs, very low credit costs, and the stocks just didn't perform. So therefore, to make that connection that now, here and now, consumption will start to fly and banks or lenders are going to benefit from that, I think possibly may not be, the argument that we really have. The argument for financials, of course, is that, you've got today an environment where, about the larger banks, about 4 or 5 large banks have got a significant access to capital. They're trading above book. Most of the rest of the private banking space is just about there. And therefore, in an economic environment where, competition is not coming through very significantly as far as the banking space is concerned, I think that the overall economic activity, which is to potentially double our economic size over the course of maybe the next 7, 8, or maybe 10 years, the banking system will do well. So I don't think it's necessarily just a play on consumption. It's a far bigger investment thesis, that of the supply side within the banking system actually being far more kind of in control and in check, given the regulatory environment that we have. And that's what makes us positive on the larger private sector banks in many of our.
All right, Harish, good to see you. And Harish, just hold on. I just want to focus on one stock. That's Oro Pharma. That one's bucking the trend. That's actually the high point of the day. As we speak, I think it's up close to around 4% or thereabouts. The news report that came in earlier said that GTCR is nearing a deal to buy the generic drug maker Zentiva. Remember, the street was a little bit cautious that Oro is looking to buy an entity that is too large. There was a fear of dilution, fear of debt in the books as well. So in that sense, the street could be viewing it as they are the lucky loser. So that's the reason why that stock is up. Harish, in the past, you've spoken about the diagnostic, set of companies. I think you all were quite bullish on there. How do you focus on, how do you play this? Pharma, till now, it's been protected from those kind of tariffs. The diagnostics, hospital chains as well, they are looking interesting. There's a longer runway, but your take, how do you approach healthcare?
So from a US generic piece, I think there are some significant one-off molecules that have boosted profit pools in the last 18-24 months that are likely to go away. And that's almost, of the aggregate profit pool, close to about 15 to 20%. And therefore, as we look at the next 18 months or so, I would imagine that the profit growth in the pharma complex especially focused on the US generics piece, is kind of going to be underwhelming. So we've kind of actually booked profits as far as the US generic piece is concerned. What we are kind of focused on, as you rightly pointed out, is on the diagnostic piece and the domestic pharma piece, where we do think that there are some interesting trends that we see. So coming to the diagnostic setup, COVID gave a leash of life for a lot of unorganized players, given the fact that there was an excessive focus of testing. And this brought in a lot of new competition. A lot of online platforms came in with significant price cuts, etc. And this, obviously impacted the pricing power of the incumbents as well as the potential for making profits. And therefore, we've seen their stocks being on the receiving end over the course of the last 3 years or so. Fast forward to 25 and 26, what we are seeing is that the competitive activity has kind of eased up. Even the aggregator platforms have actually started increasing their pricing as they have started focusing on their IPOs and their potential to create profitability from their significant loss pools that they're currently having. The third aspect is that the incumbents are also focused on getting volume growth compared to just the margin expansion, which to our mind is the right strategy from a longer term perspective. And the fourth aspect is just the hypothesis that we have that in India we are going to see a fad or a significant kind of a move towards GLP-1. And given the fact that this is going to be at a very large base of population, we do think that there is going to be testing that is going to actually take off as doctors, physicians, as well as patients become a bit apprehensive in terms of potential side effects, if any. And therefore, that will also lead to a boost as far as demand is concerned. So this is our thesis as to why we think that diagnostics are reasonably well placed from an overall perspective over the course of the next 2-3 years.
Just I know that's very well put, Harish, and explained. Just a couple of more names, right? Oracle Financial Services is up, but it's the largest volume traded stock. Although I think I saw a flash from Oracle saying Oracle Finance saying that there's no real impact of what's happened in the US from Oracle and what Oracle has done. The Oracle stock parent was up 36%. Here, in terms of the business, there's no impact, but there's, I guess, some rub off. Jupiter Wagon is coming up as the second largest gainer now. It's a small name, but 8% on Jupiter Wagon. Indocount is another one, which is up 5.5%, 300 rupees. Third largest volume gainer on the NSE. There's Moschip, which is back up about 4% after, I think it took a break for 2 days on its way up, but it's coming back. And look at Tollens, which is Tollens Tires, 11% higher. I think it's a recent listing. 196 or so on this one, and it's within the top 10 volume-led gainers right now. Phase is something which Hormuz put out, and it's got volumes, but it's up 2%. Sigility is another one which is up about 4.5%, and so on and so forth. So lots of movers coming into the mix as we go through the motions. The first few minutes as far as market opening is concerned. Harish, just as we can sort of wrap up now, right? And it's, of course, as you said, it's going to get more and more, as the general belief is, we're getting selective from here. I know you're a close macro watcher as well, and currencies is something that you watch closely. I mean, look at what's, of course, happened to the rupee here. Any implications off of that as you look ahead?
So, from a release valve sort of thing, the government response to the tariffs that have come through from the US, which have been unfortunate and not clearly as per script, has been in terms of depreciating the currency. So the dollar itself is depreciated against most other currencies, and the Indian rupee is depreciated even against the dollar. In fact, against all trading partners calendar year till date, I think we've seen a fall of anywhere between 5% to 20%. So there has been a significant let-off as far as the currency is concerned. Now, this, to our mind, has implications actually on the IT sector.
I think we're losing the
because the flowing down of revenue growth, that they'll be going at 2-4%.
Harish, go on. Please finish. I mean, I think we're losing the line towards the fag end. Go on.
Yeah. So while there has been this fear of revenue slowing down, but I think the greater fear that we had was, if the rupee were to appreciate close to about 80 because of the dollar weakness, then the margin leg for various IT services is actually in a very poor shape, and therefore there would be a further cut. I think with rupee where it is, I think that pressure of margins actually goes off. The revenue thing, like I said, expectations are quite low. It is an under-owned space. And I think, from a dark horse trade, while in the first 3 months we had private sector banks, metals and cement as the dark horse trades, now we do think that it is going to be IT services as a contrarian dark horse bet, as well as consumer, both in terms of consumer staples and consumer durables. That is where we are kind of incrementally allocating capital to kind of take into cognizance these kind of.
Okay. All right, Harish, we'll leave it on that note for today. Slightly troublesome line as well, but we got the gist of it. Thank you so much for joining in with the perspective. Well, back to the screen. And the screen's very quiet, at least at the index level, just about 9 points up on the Nifty as we speak. Mid-cap index is also fairly quiet. So it's always a good idea to look at individual stocks, and there are plenty movers in this morning's action as well. And Jupiter Wagons is definitely one of them, 7.5% higher. Let's bring in, Vinny back. Vinny, you had alerted us when we were doing our top stocks to watch. And Jupiter indeed is, rising high. Railway orders, right? They've got them from the railways. Yeah,
yes,
go on.
Absolutely. They've received orders that is coming from the Western Central Railway side. And now this order is a big one. 113 crore order win is what is coming for the company. This is mainly for supply of 9,000 Fiat axles that are used mainly in the LHB coaches. Now, what does this do for the company? Because this company will further strengthen Jupiter Wagons' railway portfolio. And they've been steadily getting order wins as well in the recent times. So that's also a good sign coming in. And overall, we've seen a bit of a decline in the stock in the recent times. So today we're seeing a bit of a up move because of that as well, and because of consistent order wins that the company has been getting over a period of time. That is interesting. Now, key will be to watch out for the execution, whether that's going to pick up now from Q2 onwards, because till now we were seeing execution as an issue coming in for most of these railway companies. Execution is going to be the key, but today the order win is keeping the stock abuzz.
Okay, all right, Vinny, got it. Thank you very much. Actually, don't go anywhere because tell us more about Aurobindo as well. It seems that Aurobindo is out of the fray now in terms of this Zentiva acquisition.
Absolutely. Now, this is what we're picking up from Bloomberg as of now, that GTCR is nearing the deal to buy Zentiva. Now, Aurobindo Pharma, TPG, they were some of these top bidders for Zentiva as well. Now, likely, obviously, GTCR, if that comes into play, then they will be the ones that is buying Zentiva as of now. And seems like they have outbid Aurobindo Pharma as well as TPG as well. Now, previously, Aurobindo Pharma, what we had heard was in the lead for acquiring Zentiva, and that time we'd seen the stock see a fall coming in. Why? Because people were concerned that, this is a big acquisition, what would be the balance sheet of Aurobindo Pharma, and that is why that fall had come in the stock when the news had come in that Aurobindo was one of the likely bidders for that. And when Aurobindo Pharma's management spoke to us on 21st of August, they said that they were in talks with Zentiva, which were in early stages, but they highlighted that they are, going to be very mindful of any acquisition that they make, given that there are so many investor concerns coming in, that the company shouldn't be overpaying. So they were very mindful of that situation, and seems like now GTCR is the one that will be looking to buy Zentiva as of now, as per Bloomberg.
Lucky loser. Thanks a lot for that, Vinny, for joining in, filling us in with a couple of stocks that are moving around. By the way, just keep an eye out at Adani Power. The stock was down close to around 5%. I'll tell you what, there was a large trade that took place. That large trade got cleared out of the way, and the intraday chart comes up for you on the screen. The stock has recovered close to around 6.5–7% from the day's low. So just keep an eye out on that one. Very, very large trade is what we saw in the initial minutes of trade.
Absolutely. It was also in the news. It's, with, I think, MP Power, LOA, for supply of 800 megawatts of power. So that's on the business side, and then there's a block on the trading side that has just happened. For the time being, we're putting the spotlight on the financial space, and it's time to talk to the management of Chola. Mr. Arun Selvan, President and CFO at Cholamandalam Investments and Finance, is with us. Great to have you back on the show, sir. So, we want to focus on a couple of specific points. Let's just lay them out for our viewers. Number one, we want to understand how disbursements will perhaps shape up. Will there be improvement? Are your projections higher now for the year after the GST cuts? Of course, in the first quarter, we saw some hint of a little bit of a stress in vehicle finance. Let's find out if those trends are changing, if they're easing off. And then, of course, an outlook on the net interest margin. So, Mr. Selvan, good morning. Let's start with the first one, right? The GST bonanza coming through. But, you know, in a very simplistic term, if I just break down the math, let's say if I was taking a loan from you for, 20 lakh rupees for a vehicle, now with the GST cut, maybe I need only a 15 lakh rupee loan. So in an absolute sense, that's lower, but maybe demand will be higher. Maybe Nigel will say he also wants to, buy a new car. So will higher demand offset the actual, reduction in prices? You've told us 20 to 25% growth, AUM growth this year. Will you be looking to increasing those estimates?
You are absolutely right that, there is a value reduction that will happen because of the GST being lower. There are two sides to this GST, reduction. One is the value, the overall, to answer your question, overall, in our view, the AUM growth, we still will hold it at the 20 to 22% levels for the full year. We will be reaching this, and there should be benefit with the number of units being sold because of the reduction in GST. And while that would have a slightly lower impact on the value, so overall we don't want to change it either positively or negatively because of the GST reduction coming into play.
But sir, earlier you said a rough growth guidance of 20 to 25%. Now you're saying 20 to 22%. So is that a slight trimming?
Yeah. There will be, we need to be, I think we even moderated it to 23%. So 20 to 23% is the numbers which we are right now working towards. It will be predominantly driven by mortgage, and then there will be 18 to 20% growth on the vehicle finance. Mortgage should grow around 25 to 30%, which comprises of the LAP, HL, and the SBPL book, which we combinedly call it as the mortgage book. We had consciously taken call on reduction in the CSEL business while we have articulated this. The fintech business has come down. And in the SME, we have slowed down on the supply chain. So these two are taking away some, growth from the disbursement side of it, while it will have very small impact on the AUM growth. So the AUM growth will remain, we still keep it at the 20 to 23%. That would be the level we are looking at for the full year. To just answer another part of the GST implication would, also mean lower EMI burden to the customer, which would mean it will improve credit. Just wanted to add that part to it.
All right. Hi, Mr. Selvan. Good to see you in. On Surbhi's point, Nigel is not looking to buy a car. But if in case I do approach your team, I've got very good credit worthiness. Never defaulted. So the track record is clean. Got that. All right. Let's focus on the disbursements then. Earlier you were guiding, I think, for around 10-12% growth. Do you think ultimately that will come about? Because, quarter two has its own share of challenges, whether it's the floods, whether the economy is still a little bit weakish. And now you'll have, some kind of uncertainty with regard to the rollout of GST, apologies for that. The second half of the year, though, is expected to be far, far better. Do you think that 10-12% disbursement will be achievable?
Yes. See, you are right. It has always been a case that this Q2 will always be a slow quarter because of rains and also because it has got a fair share of the period coming under inauspicious months, etc. This is more so in the case of vehicle finance. So you will see this impacting disbursement. But certainly, we feel that the disbursement would be better than first quarter across all the businesses. While it may not be significantly larger, AUM growth would be better. So as we have always been stressing that we look at AUM growth because that is the one which ultimately brings the interest income rather than the disbursement number per se. So AUM growth we still hold at the 20 to 22%. We should reach that number for the full year. And certainly the festival season and the good monsoons would augur well for the Q3 and Q4 numbers. that's the current sort of estimation that we run with.
Got that. Mr. Selvan, good morning. Prashant here. Just a quick point before, of course, I mean, this will help in many ways, GST. I mean, second order, third order derivative impact, etc. So it's all in the positive direction. But otherwise, across the industry, not for Chola. I mean, Chola is really at the top end of things in terms of growth, etc. But loan growth has been a bit of a problem. I mean, it's not panning out in numbers maybe yet, but feedback is that collections perhaps are taking a lot more effort across a range of financial companies, especially NBFCs. Is that true? And is there something which we will see over the next couple of quarters?
Yeah, it is true to some extent. I think that's the second part of your question, which was initially spoken about. Yes, there is a little bit of a higher stress on the collection, more so in the case of vehicle finance. But I think this again is a routine that we have seen earlier pre-COVID. During the COVID periods, we did not see this because the numbers were very high, and so it did not really show up. But we generally will have this cycle coming, like Q1, Q2 will always be a slower quarters. Q3, Q4 will be always a better quarter in the case of, especially in the case of vehicle finance. This sort of cyclical movement has started happening in vehicle finance post-COVID now that things have settled down. So you'll see that, panning out in this quarter as well as, and improving in Q3 and Q4 when the festival season starts. This is primarily because the vehicle operators get more loads during the period of festivals and the harvest, which is when they will earn more and they will, be able to service the loan better. These are earn and pay type of customers, especially our customer profile. So there will be these sort of a slight fluctuations between the quarters.
My question was a little more broader, not the segment per se. I mean, if you rewind the clock, right? I mean, tightening by the RBI started sometime, I think, in late 2023, right? Risk weights went up, what banks lent to NBFC, and of course, what NBFCs further lent out. Then this MFI issue trouble started sometime in middle of 2024, right? Q1, Q2 of 2024. That segment, especially the MFI segment, because it touches so many households. I think 7-8 crore borrowers. So the number of households it touches is enormous. The spillover of that, I mean, is that fully understood? I mean, the slowdown in that space, while that segment may see repair and recovery, and we talk about it from a stocks angle, but is that critical for reviving lending growth? There has been a bit of a pause. And that needs to start again. That cycle needs to start again. Is that an issue?
Both the MFI and the personal loan type of lending segment is based on unsecured lending, where there is no underlying security being offered by the borrower. So there is a tendency that these segments would grow faster when there is a lot of demand, and because this leads to sort of over leveraging by the customers. But in a secured lending, ultimately the borrower has to bring a security to the table to take a loan. So in a secured lending, this becomes a little bit more organized or a little bit more controlled, that they have to find a security to start or to come and offer for a lending, whether it's gold, whether it is vehicle, whether it is mortgage. The second thing is, when you are lending to your business purpose rather for a consumption purpose or a discretionary spending purpose, then the responsibility that you see with the borrowers is much more significant compared to a discretionary borrower. Or a borrower, or a person borrowing for spending on a discretionary item, like buying a expensive bike or buying a consumer durable, which are not really up to his living standards. So this over leveraging tends to happen, especially like recently we're seeing a lot of people going on holidays, borrowing. which is, these things make them borrow and then get into trouble. So this is being what is getting curtailed with the recent actions of RBI, and this is where you are seeing this reduction happening. So the unsecured lending is where you will see more of these failures, and that's what we have also been slowing down on the unsecured side.
Sure. Speaking of unsecured, Mr. Selvan, just give us an overall picture on how asset quality and credit cost is moving, because in the first quarter there was some niggles over there and there was a slight rise in credit cost. If I have the right numbers for the full year, I think you're guiding for credit costs to be roughly 1.5%. So just tell us how the trends are shaping up in Q2 across various segments, whether it is vehicle financing, LAP, etc.
Yeah, see, for the full year, the overall credit cost would be in the range of around 1.5 or even 1.6%, as somewhere equivalent to last year levels. And if, God forbid, the monsoon gets extended into Q3 like it happened last year, then it can even be slightly higher. But going by the trend to now and going, as I said earlier, the GST impact will also have a better implication on the collection side, because the ability of the customers to pay becomes more is improved because of that lower burden on the EMIs. These things should start playing out, and that would have a positive impact. So we will be in the range of around 1.6% on the overall NCL level. With regard to unsecured, the increase you are seeing is primarily because we are not growing the book on the fintech. So when the growth is not happening and you are cleaning up the book, this generally tends to move up, and that's what we are experiencing.
Sir, on the credit cost, I mean, your exposure to the north is very less. But given that you are present slightly, could that add some more pressure, upward pressure to credit costs because of the massive flooding and disruption that we've seen?
Yes, it does in the segments like Punjab, Arunachal Pradesh, etc. But thankfully, in those particular states, our exposures are being minimal. But this is something which happens every year. Sometimes there's flood in Kerala, like there are years when there was floods in Kerala or in West Bengal or in. So, if you look at our geographical spread, we are not concentrated on any state where our share of volume is even in double digit, maybe other than Maharashtra. So to that extent, a system is built. That is the whole point of this diversification with regard to business, with regard to geography, with regard to customer profile. It helps us manage risk when certain pockets get impacted.
Got that. Very, very useful conversation. And Mr. Selvan, those holiday loans are real, sir? I just thought they were...
Oh, they are plenty, but we don't do that.
Loans for holidays?
Yes. It's a standard. You can get offers on the on any app.
I have to get leave first. Then I will let you know. All right. Thank you very much, Mr. Selvan. I appreciate you joining us, and important differentiation. And I think that's why you've done well with regards to some of the secured lending that you're doing. But yes, on the unsecured side, it is a bit of a problem. We'll take a quick commercial break here. We're going to come back with Anupam Rasayan management on the other side. Gopal Agarwal, CEO of the company, speaking with us on the company's export outlook and a lot more. Stay tuned.
Welcome back. Well, let's get to our next guest. We have Mr. Gopal Agarwal, the Chief Executive Officer at Anupam Rasayan India, who joins us on the show. Hi, Mr. Agarwal. Thanks a lot for joining in, sir. Just coming to you. But we've got three big talking points that we want to discuss with Mr. Agarwal. One is the export market outlook. Second, the working capital improvement. And third, the commercials of various contracts as well is what we are looking at. So let's get straight to the point then. Mr. Agarwal, thanks a lot for coming on the show. Well, exports are approximately 58% of your order book, right?
Yeah.
A lot of it is coming in from the United States as well. Could you tell us first, what does this 50% tariff mean for you? And what are your customers, your clients telling you, post this imposition of these tariffs? Please go ahead.
So first of all, let me clarify, currently, I would say almost 60% of our export is to Europe. Another, I would say 20-25% is Japan. And as far as US is concerned, it was roughly, I would say more like 2-3% of our revenue, which is likely to grow to, let's say, 10% of the revenue this year. So from that perspective, it's not that US was a significant part of our exports. Having said that, honestly, we are not seeing, let's say, much of a challenge as far as the customers are concerned. They have continued, to ask us to kind of build on, let's say, the production. We have not heard from them, any kind of a disruption as such, wherein, they are wanting us to kind of, let's say, slow down the production or anything of that sort. That's number one. Two, as I said, for us, the exports is across Europe as well as Japan. And on those geographies, leaving, let's say, US for a moment out, is growing significantly. For the kind of contracts we have signed, currently, let's say, for example, my Japan revenue is roughly around 16-18%. With the contract in place, in 2 to 3 years, my Japan revenue could be easily 1/3 of my overall revenue. So from that perspective, we are pretty well diversified as far as our exports are concerned. So yes, would there be kind of a, let's say, some short-term impact of the tariff? The answer is yes, but I don't really see that should really impact not only us, but any of the chemical guys in the long run.
That's good clarification. So currently, US is extremely small, 2 to 3%, but you're saying that it could go to double digits. By when does that happen?
By the year end.
By the year end. All right. Got it. Let's move on then. Your order book, I think if I got that number correct, is around 14,600 crores. You have around 15 orders, out of which 11 are still letter of intents. Could you tell us when do these become final agreements? When do these contracts get commercialized? Some broad idea in terms of margins?
So thanks for asking this question. See, in our case, letter of intent is as good as a contract. The way it works is that before we get into signing a letter of intent, it's an effort of anywhere between 2 to 5 years, wherein the product goes through all the, what would you call, certification. Let's say in case of agro registration, in different geographies, it passes through, let's say commercial test, pilot test, and all of that. So LOI for us, it's a more of a nomenclature, which is just kind of, let's say, at the fag end of a contract. And in fact, in some cases, we even start supplying commercially, on the basis of LOI itself. Number two, all of these LOI, given most of our customers are MNCs, it does require a board approval from their perspective. So, for all practical purposes, I would say these LOIs are as good as contract.
Can you give us some idea about your working capital? Because you have indicated that there's been a big increase in working capital. So from how many days to how many days? How long do you expect this to last? And what are the options available to try and kind of limit the impact?
So, Surbi, I would say maybe a bit of a longer answer to this. Given the kind of a business we are into it, we are largely a B2B player, working with, I would say, the top-notch MNCs. And our contracts are basically long-term, which run anywhere between minimum of 5 to 7 years. Of course, we have had, situation where, some of our customers and product contracts have been running for maybe about 20 years or 30 years. So that's kind of one part of it. Given in most of our, let's say, contracts, we are either the primary or the exclusive supplier to our customer. So, while I may be supplying, let's say, a material or a molecule worth 10 to 20 million dollars, to my customer, but his end molecule is maybe worth $1 billion. So from that perspective, I become pretty, let's say, important, to ensure that the supply chain is kind of taken care, without which, his end molecule could be a bit of a challenge. And which is where, as part of the contract, we are expected to maintain anywhere between, let's say, a overall inventory of 5 to 6 months, given the criticality of the product. And, we need to have certain amount of stuff at our plant, certain at Indian ports, certain at foreign ports. So from that perspective, I would say for the kind of business we are into it, and given the kind of EBITDA margin, of anywhere between 24 to 26%, which we enjoy, we do have, let's say, a working capital cycle, which is 6 months. Having said that,
6 months.
Yeah, having said that, there were definitely a bit of a, I would say, headwinds, across globally, for the chemical companies and agrochemical in particular, in last, I would say, 6 to 7 quarters. So to that extent, one has definitely seen a much higher working capital kind of accumulating, for us. But if you would see, my Q1 numbers, very clearly, you have seen a significant jump in our revenue. I mean, our quarter, year-on-year revenue, my Q1 FY25 revenue grew almost 100% compared to the last year.
Absolutely. No, Mr. Agarwal, I understand it's the nature of your business. We're just trying to get an idea about the number. I'll come to the growth as well.
Yeah.
So just quantify this, given everything that's happening and the tariffs for now they're here. But what is the visibility? How much will you grow your top line by this year? Can you retain margins at around 26%? And what will be the number of working capital days?
So as far as the growth is concerned, again, I think if you take out those 2 years, we as a company have grown at 25 to 30% CAGR, and we will continue to grow at that or even higher, given the kind of a contracts which we have signed, let's say, over last 2 years. That's number one. Two, as far as the margins are concerned, most of our contract, would have margin anywhere between that 22 to 26%. So from that perspective, I think we will maintain our EBITDA margin even going forward. As far as
you will maintain the margin, correct. And the revenue you said for this year?
For this year, as I said, I can't kind of guide you, but you have the Q1 number. If that is any indication, I can tell you. As I said, we are more than going to come back, to the glory days for sure.
All right. What about pharma revenues? They used to be at, I think, around 25 crores, or that scaled to around 75 crores. Could you tell us, is this LOI based, non-LOI based, and where do you see this number headed?
So pharma, our strategy, is very clear where, we are making what we call as KSM, key starting material. And this is basically an import substitute. And as far as the percentage is concerned, this year, my pharma revenue would be 20% of my overall revenue. So pharma has grown, I would say, very significantly for us compared to maybe, let's say, 4-5%. It's almost going to be 20% this year. And we do see, this number growing, let's say, both in terms of absolute and even in terms of percentage. So pharma has been definitely, I would say, one of the what we call good kicker, in terms of the growth for the current year as well as going forward.
Okay.
Yeah.
Yeah, Gopal, back to glory days. Look forward to it and look forward to our next conversation. Thank you very much. Good luck as you execute at Anupam Rasai. Thank you very much. I just want to make a quick mention of two names if we can. I know we have an important conversation, but pull up Indoco Remedies. Stock is shooting up 13-14%. I'm not sure if there's any news flow. That is Indoco. And the other one is Piccadilly. Piccadilly, huge volumes and stocks up 12.5% as we speak. So that is Indoco. And the other one is Piccadilly, which is the alcoholic beverage company, which is at about 717 at this point in time. All right, there you go. That's the one. The big conversation from the auto space, right? Let's now go across to the 65th SIAM conference for a CNBC-TV18 exclusive. Tarun Garg of Hyundai Motor India, my colleague Parikshit, waiting to interact with him. Parikshit, over to you.
Well, yes, the SIAM convention has kicked off in New Delhi. It's the annual gathering of top automobile leaders and thought leaders here in the capital. And with us is Hyundai's Chief Operating Officer and whole-time Director, Tarun Garg. Mr. Garg, thank you very much. Welcome to CNBC-TV18. We're kicking off the SIAM convention coverage with you. Let me begin by asking you about the GST cut and how is it immediately giving a positive impetus to sales, demand and bookings?
Parikshit, thank you very much for having me here. And at the outset, we at Hyundai Motor India Limited would like to really thank the Honorable Prime Minister for ushering in these huge GST reforms. We believe very strongly that these reforms are not only going to really give a huge impetus to the economy, but specifically talking about the automobile industry, very, very positive. You mentioned about the initial response. I think the response has been extremely good. There's a lot of enthusiasm in the entire chain, not only from dealers' perspective, the customers, the bookings. Last few days, the booking momentum has really gone up dramatically. well, and we are very happy because, as you know, the biggest festival of India, starting with Navratras, is just around the corner, and then followed by Diwali. Of course, the marriage season. I think these GST reforms have really come at the very, very right time.
All right. Could you give us a sense of the kind of growth that you're looking at in the festive season? I know it cannot be a month-to-month comparison, but overall, this festive season compared to last year, the growth?
So, Parikshit, if you see, the CAGR, 5-year CAGR for the Indian industry has been at about 4.5% to 5%. However, because of the geopolitical situation and whatever is happening around the world, we saw that this financial year, April to August, the industry is at about -2. I believe now there are about 7 months left in the year. I think kick-starting from September, hopefully we would achieve the CAGR growth, so maybe this about 5%. So -2, the swing will be about 5%. So 7% swing from -2 to 5, I'm expecting going forward. September onwards, not only for this financial year, but going forward as well. Let me tell you, I have been in the industry for 32 years. At least last 20 years, never before such a big change has happened. So earlier, excise duty went down sometimes by 4%, 6%, at the max 8%. But this GST is 10% cut, especially for less than 4-meter cars. I think it's absolutely fabulous, and I believe this will be a huge impetus.
So expecting a 5% growth overall in the festive season and for the full fiscal?
Yes, I said for the period coming now. So September to March, probably we can look. Look, it's very difficult to really have a very exact number, but I believe that the swing from -2 to 5 is just around the corner.
All right. Now, in terms of surge in bookings, is there an actual surge that you're seeing both in rural and urban areas? And what would be the quantum of increase?
Yes. So there are 2-3 things which are happening here, in fact. One is rural, as it is last 2-3 years, was doing very well because of the infrastructure, because of the good monsoons, the minimum support price. So at Hyundai, the rural penetration had gone up from 19% to 23%. And also the SUV contribution in rural had gone equal to the urban contribution, So we are seeing now, the good thing is last 2-3 days, it's too early to say, last 2-3 days, both rural and urban are showing a very positive uptick. Of course, customers are booking also in anticipation of the Navratras. As you know, Navratras are very big in West, in North, in Central. And also some of the customers who had withheld the purchases, like for Onam and all, are also coming out now and booking for the post-GST.
Okay. To speak to you about your growth in exports. Now, you are reporting double-digit growth in exports in FY26 so far. How do you see it for the rest of the year?
So I think this is a very, very important point, Parikshit. If you see, I would say that exports anyway, because of the situation in the domestic market and the macroeconomic situation, like I said, the industry was not really growing last few months in the domestic market, but we had an impetus on exports. We are very, very strong. We are outside of Korea, we are Hyundai's biggest base, especially for the emerging markets. We believe now it will be a double engine growth. So exports will continue to grow. Like I said, 12.5% growth already April to August. Going forward, we believe we have already given a guidance for about 9% for this year. Now that the domestic also starts coming into growth, this will be like a double engine growth for Hyundai. And to add to it, the new plant is around the corner. I think come October, we'll have the SOP of the Pune plant. We are all very excited because our capacity goes up from 824,000 in Chennai to now 170,000 more. So we are almost reaching close to 1 million. I think we could not have had a better timing for the Pune plant.
Right. Could you give us a sense of when will this Pune plant come on stream?
So like I said, Q3 of financial 25-26, the Pune plant will come on stream, and the phase 1 will have 170,000 capacity, which starts kicking in right from the first month.
Right. How do you see the GST changes changing consumer preferences in terms of buying cars? Because the EV cost differential has come down. Hybrids also will now be taxed at the same rate as ICE in small and large cars.
So look, there will be many things which will happen now. I think one is, if you see at the base of the pyramid, the car penetration in India is only about 34 per thousand. I believe with the 10% cut in the smaller cars, it will bring in so many new customers. The first-time buyers, which Hyundai anyway is seeing a big jump. First-time buyers in 2020 used to be about 31%. Now they are at 39.5%. I believe we have a potential to go up to maybe 42-43% in first-time buyers. So more small cars selling. The second thing I think which will be much more significant is, if you see the customer affordability remains the same in terms of how much he can spend. However, the car becomes cheaper, which means its initial signs, maybe the customers will now again go back to the higher trims. Because last 1 year we are seeing that customers were moving down from higher trims to middle trims to lower trim. But now there's an opportunity because India is a very, very aspirational country. And again, I think customers will want not only safety, but connectivity. We are seeing a huge jump in the ADAS level 2. We are seeing that connectivity is going up. We are seeing sunroofs. We are seeing customers wanting the better stereo system. AVNT. So my point is that the aspirations will also come in. So this is the second part of it. The third part of it is, if you see, I think it's a very simple GST structure, no complications, no SAS. So I think the opportunity is there for everybody to grab, whether it is petrol, CNG, whether it is, like you said, electrics. You mentioned that the gap is reducing between small cars, petrol and electric. But I would say, if you see the momentum of electrics, last couple of years, electric was somehow stagnant at 2.4%. But this year, if you see, in August, the penetration has already reached 6%. So this is a huge jump. I think the direction is very clear. Customers are really buying it, not only from a total cost of ownership point of view, but also from the commitment to environment point of view. And more charging infrastructure is coming up with the PM E-Drive scheme. And Hyundai also, if you see, whether it is the AC chargers, almost more than 950, DC chargers, 119, the big highways in India, we are going very aggressive. By 2032, we believe that the DC chargers will be upside of 600. So the entire ecosystem is going to support the EVs. We have already announced 26 new models, including upgrades by financial 30, which will have EVs, which will have hybrids as well. So I think the opportunity is there for anybody to grab. India is a very big market. Right. Every geography, every segment behaves differently. I think whether it is EVs, whether it is petrol, CNG, hybrids, everybody will have an opportunity.
So how much of your portfolio will now be in the 18% tax bracket? How much in the 40% tax bracket, and how much in 5%?
So that is $1 million question. As of now, we are 60% in the 18% bracket, and in terms of IC engines, and 40% in the 28% bracket. Let us see, because if you see last few years, customers are moving towards SUVs. But at the same time, I believe, and this is, I'll stick my neck out, I would say in the less than 10 lakh rupees segment, especially the extra segment, could see a huge growth, because that gives the customers the space, the SUV like body type, the ground clearance, the safety in terms of 6 airbags, the style, as well as the affordability. So I think I am really betting that that segment will see a big growth, because that takes care of the price as well as aspiration. Right. And like I mentioned, going forward with our new product cycle coming in, I think we have across the range, we have huge opportunity, and we are going to really go for it.
All right. So would you say that sub 10 lakh is a segment you'll focus on aggressively?
I would say sub 10 lakh anyway is contributing 60% to our sales, and customers have been moving to more than 10 lakhs. If you see, plus customers have been moving to SUVs. I think what this GST cut will do is that SUVs in the less than 10 lakh segment will probably see a very big growth, and there is a huge opportunity there, especially if you are able to give the customers the right features in terms of connectivity, in terms of ADAS, in terms of sunroofs, in terms of automatics. I think this is one very big opportunity.
Okay, well, that's a very interesting conversation with the top management at Hyundai Motor. 2488 stocks absolutely flat right now. We'll slip into a quick commercial break here. On the other side, Somal Mehta will be with us of Mirae Asset Sher Khan for a quick technical check of things coming up. Okay, markets kind of come off and cooled off a little bit. We had a nice run off the lower end of the ranges. So today it's a little flattish and quiet. It's been that way from the morning. We have Somal Mehta of Mirae Asset Sher Khan who's with us now. Somal, good to have you with us. Thanks very much. So what's the plan from here in terms of trades? And let's start with indices. We'll talk about some stocks.
Hi, Prashant. Good to be here on your show. overall bias remains positive. We may just be in this range between 25,000, 25,200 is the upper end. Lower end would be 24,600, 24,500. So that's the range. We might just stay in this range. But the plan is that we should focus more on sector-specific, stock-specific action. There are a lot of sectors which are doing good. In the last couple of days, I think PSU banking has started doing well. Defense sector has started doing well. So I'm focusing more on those side. Stock-specific, pharma stocks are doing great. So the plan is to stay more stock-specific and not go into Nifty trading or bank Nifty trading, because they are in a range. It's been in a range for a very long time, and the support and resistance everybody knows. So yes, at this time, I think we may just take support around 24,800, 24,700, and again resume the uptrend. And I'll be expecting the previous swing highs to break on the upside, which is around 25,600, 25,700. So yes, positive on the markets. Nifty, bank Nifty, both buy on decline should be the strategy.
Yeah. Buy on decline should be the strategy. Stocks, Somal, what's on the radar?
Defense, that's the first thing I have in my radar. Mazgaon Dock looks great. Small triangle pattern has broken on the upside, taken support at 200 daily moving average. Looks great. Stop loss should be 2720 and target would be 3,000. That would be my first pick. The second one is Concor. Good momentum today. So Concor has broken out of a small consolidation on the upside, taken support at 20 daily moving average. Great setup. Stop loss should be 535 and target would be 590.
I think Sudarshan had a call on Mazgaon as well in the morning. So Mazgaon is one, and the other one is Container Corporation. So I'm going to get those trades from you, and of course that view as well. Appreciate it. So that's Somal with Mehta with perspective on markets. Let's talk about one name now, Eternal, where we want to just run you through some brokerage calls which are coming in. Hormuz is here with that. Hormuz, over to you.
Eternal doing well today. JP Morgan has raised its target on the stock, and an outperform recommendation here, a 390 rupee target now for Eternal, implying around about a 20% upside from yesterday's closing levels. And they mentioned that the recent data channel checks that they have done is confirming the fact that Blinkit is expanding its leadership over peers in multiple ways, and they are also mentioning that they can sustain Blinkit can sustain the higher growth for a longer period of time, and this is without extending their break even or turning profitable timelines. And JP Morgan has also gone on to say that they will prioritize market growth over maximizing profits over the next 2 years, which is also evident from the kind of store expansions that Blinkit has done over the last couple of quarters, and as a result of which they have increased their quick commerce gross order value expectations for FY 26, 27 and 28 by 6%, 22% and 35% in that order. But the EBITDA estimates have been left largely unchanged. So positive commentary coming in from JP Morgan with regards to Blinkit raising their price target. The stock as a result doing well today.
Okay, all right. Got that, Hormuz. Thanks very much for the details. We will get into a very quick break after this, and then connect with the management of MTAR Technologies. Yesterday, MTAR announced a number of orders, almost 400 crores of orders, which they'll get from Bloom Energy, which is a US-based big company in the clean energy segment. We'll find out more after the break. Welcome back. The next company on our radar is, excuse me, MTAR Technologies. We have Mr. Parvat Srinivas Reddy, MD at the company, joining in to take a couple of questions. And the company recently announced some fairly significant orders that they would be fulfilling for Bloom Energy, which of course is a company in the clean tech space. Bloom is a US entity. So the three talking points: we want to understand the scope of these new orders, the outlook on the rest of their businesses as well, which includes areas like nuclear science as well as defense, and the overall impact of US tariffs. Mr. Reddy, thank you so much for joining in. So let's start with these new orders. about 380 odd crores. You've had an ongoing, association with Bloom Energy in the past as well. I believe that these are components that you'll be supplying for things like hydrogen fuel cells. How large is this business for you? How much of this business, which is clean energy, how much is it contributing to your revenue now? And with these kind of orders coming in, what will be the contribution going forward? Just tell us everything. Margins on these orders, when do you deliver them, and when do you book it in the P&L?
The first thing is the orders what we announced is for the next calendar year. That's from January to June. In 6 months, we have to execute close to 400 crores worth of orders. I can't go into the specifics based on certain NDA signed, but if you look at the overall picture compared to this year to next year, it's close to 100% of revenues, more revenues being generated only in the clean energy segment. That's the kind of demand what Bloom is looking for in terms of the order execution for next year. So it's almost like doing twice as much as what we're doing this year.
Absolutely, and it's very significant, sir, because if I look at your FY25 top line, you did 676 crores of revenue. Yes. And now you've booked orders worth almost 400 crores. So it's significant. These will be executed over what time frame? So just trying to understand whether it's more over FY26 or FY27.
It's, as I said, it's over 6 months period from January to June. And then you'll see a similar orders being coming in from July to December as well. So technically, you're looking at almost like 750 to 800 crores of orders, which have to be executed within a 12-month period of span.
So, sir, I mean, since the focus is really building on clean energy, I'm trying to understand the composition of your revenue pie. Will it then be predominantly clean tech, or will your defense business, space business, nuclear, will they keep pace? I'm just trying to understand the revenue mix, say, 12 months down the line.
Obviously, with 100% growth in clean energy segment, you can't expect similar growth in other segments, right? So we have been working on this segment for the last 10, 12 years. And I've been saying this all the time that the kind of development activity we have done, innovation we have done over the years, you are seeing the results now and even in the future. But not that we are doing extremely well in nuclear as well. We are expecting huge orders coming in from nuclear division as well. And that's something we are looking forward to because we have enough technology and capacity to handle that as well. So I think overall, if you look at it, the growth in clean energy segment is very rampant. But we also will have it cannot be as rampant as clean energy, but there will be a substantial growth in nuclear segment as well.
Nuclear is also clean, right? On a lighter note.
Yeah, on a lighter note, yes.
Sir, morning, Prashant here. You did what, 700 crores in revenues in 25, FY25?
Yeah, we did about 675 or 680.
Yeah, 676 or so. What is, say 2 years, so forget 26, 27, 28. What kind of numbers do you have in mind, sir, with all of this sort of coming together?
I mean, we should cross beyond 27, 28. We should be going beyond 1,500 to 1,600 crores very comfortably. The way we are looking at the kind of orders that we are getting and the kind of innovations that we have done, not only in clean energy segment, but also in nuclear and aerospace divisions as well. So we'll go close to that mark.
Yeah. So almost basically next 3 years, you're talking about not 3 actually, 2.5 now, half the year is done for 26. You're basically looking at almost 2.5 times growth.
Yeah, if you look at 27, 28, probably 1,500 crores is what we're looking at. So
yeah,
that's where we are looking at, right?
And margins would broadly be in this region?
Yeah, they would be broadly in this region, probably with a higher revenue growth that we're going to have. Obviously, for the current year, we said 25% would be the growth. But if you look at 26, 27, the growth would be much higher. I can't quantify it right now. It's too premature. But if you look at the kind of orders that we're getting, the important thing is these orders have to be executed within 6 months to 12 months period. Like, for example, in the case of clean energy, it's not like spread over 4 years, 5 years. So that itself is getting you a lot of operational leverage in terms of improved margins. So let's see how it goes. But overall, yes, we will be moving closer to that, crossing the 1,000 crore mark next year for sure.
Just one last question from my side. What's the on the nuclear front? I mean, we are one of the few countries which has been building reactors, right? The building plants, etc. And there's an ambitious plan. There's now SMRs, and you are already supplying to Nuclear Power Corporation, etc. Or you'll start now?
We're already supplying. We are executed some projects. We are doing it for the Gorakhpur project right now, the 700 megawatts. And Kaiga 5 and 6, we are in discussions right now.
And what exactly are you supplying, sir, here on the nuclear front?
It's completely the nuclear island. The most critical equipments for the nuclear reactor is what we specialize in, which is really very key to the entire nuclear reactor. We don't get involved in civil, but on the mechanical side.
What is that? I missed that. For the reactor?
For the entire nuclear island, the entire mechanical equipments, what is it for the reactor, the coolant channel, the fuel handling assemblies. These are all very key to the whole reactors.
Yeah, some very, very nuanced engineering over there. Final question, sir. This order to Bloom, I mean, these are going to be supplies that go to the US, right? So just trying to understand, what is your total US exposure right now and what happens to tariffs? I mean, it's under what kind of tariff? Not sure if it gets excluded, or if you could just tell us.
It's not excluded. Nothing is excluded right now, right? So it all depends on the demand, what the US companies have and how to take care of that. So because it's on the technology side and the entry barriers are tough, the capacities have to be in place. These things don't take, doesn't happen overnight. It takes 3-4 years or 10 years for people to even think about this.
But the components that you will ship, they will, for now at least, they will attract 50% tariff, right?
They will attract 50% tariff.
Got it. But it's such a strong sign, right? If there are, if there is precision engineering, if products and services from India are top notch, then there is a demand. Where there's a demand, I mean, their products are going even at 50% tariff. Thank you so much, sir. Great conversation and good luck to you for all of those plans. Well, that's MTAR Tech. And as we have been speaking, take a look at what the stock has done from. It started off from a flattish note, and now it's moving towards the higher points of the morning. Well, with that, it's time for us to wrap down this session of Bazaar. Thank you so much for being with us. Chartbusters comes up next.